Good morning once again. We'll be starting in just a few minutes. We're very delighted to host the 4th AMRO Forum here in Hong Kong, China. Also live stream via Zoom, YouTube, and NovaWeb. To our online audience, thank you for joining us. Please make sure you're logged in and ready for a full day of discussions. Thank you. Distinguished guests, ladies and gentlemen, good morning. On behalf of the ASEAN+3 Macroeconomic Research Office, AMRO, the Hong Kong Monetary Authority, HKMA, and the Bank for International Settlements, BIS, a very warm welcome to all of you to the 4th ASEAN+3 Economic Cooperation and Financial Stability Forum. Also, a special welcome to everyone joining us virtually. My name is Sonia, and it's my great honor to be your MC today. To kick off our program, may I invite everyone to turn your attention to the screen. This forum serves as a key platform for regional and global dialogue, bringing together policymakers, experts, and academics to exchange insight on economic cooperation and financial stability in ASEAN+3. Now, in its 4th year, it continues to spotlight the challenges shaping the region's economic growth and financial stability, and the policy actions needed to address them. To officially open the forum, may I invite AMRO Director and CEO, Mr. Yasuto Watanabe, to the stage. Please welcome.
I'm afraid I ate too much the good dinner last night. Distinguished guests and ladies and gentlemen, it's a privilege to welcome you to the 4th AMRO Forum, co-organized with the Hong Kong MA and BIS. My deep appreciation goes to the Mr. Edu and Mr. Dantao, and also to our distinguished speakers and panelists, and all of you joining us both in person and virtually, for being here today. From fragmentation to resilience, the theme speaks directly to the reality facing the ASEAN+3 region and the global economy. The world is undergoing structural change now. Supply chains are being rewired, trade is increasingly shaped by strategic consideration, and technology has become contested terrain. The monetary and financial system is evolving. From growing interest in currency diversification to the emergence of the parallel payment architecture and shifting capital flow patterns. Yet the world remains deeply interconnected. Capital continues to move across borders. Policy decisions in major economy reverberate through our market instantly. Finance institutions remain globally active, and our markets still react to the same global risk signals. We are navigating the world in transition, no longer defined by the old rule of globalization, but not yet anchored in a new and stable order. Amid global fragmentation, the architecture of interconnection needs to evolve. The implication and especially profound for the ASEAN+3 region. Our region sits at the heart of global economic realignment and contribute more than 40% of global GDP growth. What happened in the world economy matters to us, and what we do as a region increasingly shape global outcome. The choices ASEAN+3 make now on integration, cooperation, and the future architecture of financial system will influence not only our own trajectory, but the stability and resilience of the global system. Today's discussion will confront this issue with candor and ambition. This morning, we focus on navigating macroeconomic risks in a fragmented world. The fragmentation will continue, but deep integration remains one of our strongest anchors. The strengthened buffer and aligning policy will reinforce the region's collective resilience. In the afternoon, we turn to finance. Markets are evolving rapidly, driven by the non-bank intermediation and the powerful wave of digital innovation. Just 2 weeks ago at the Singapore FinTech Festival, I witnessed firsthand how global innovators from the major finance institutions to the cutting-edge startups reimagine the payment, tokenization, and the very architecture of the financial services. The message was unmistakable. Technology is rewriting the nature of finance. These developments bring enormous opportunity for ASEAN+3, but they also open new channels for shock. Our task is clear: harness innovation with confidence while reinforcing the frameworks that keep our financial system stable. Across both sessions, one message will guide our discussion. Resilience in ASEAN+3 is not achieved through isolation. It is built through adaptability, diversification, and the capacity to absorb shocks without losing cohesion. To achieve this, ASEAN+3 must continue to move with purpose, deepen financial cooperation, accelerate investment in digital and payment infrastructure, and strengthen the institutions that enabling collective action. AMRO is fully committed to this cause. We will continue to enhance our surveillance and expand our technical assistance and reinforce the region's financial safety net in support of the region's evolving needs. These challenges are complex, but the experts gathered here today, both on-site and online, is exceptional. I'm confident that our discussion will yield concrete insight for the next phase of regional cooperation. Let us use this forum to think boldly and to speak with the voice of the region that is shaping our own future. Thank you very much.
Thank you very much, Mr. Watanabe, for your inspiring words. Echoing this year's theme, fragmentation to resilience, macro-financial stability, and regional integration in ASEAN+3, Mr. Watanabe highlighted that in an era of global transformation, our region faces the dual challenges of safeguarding financial stability and strengthening macro-financial resilience while sustaining long-term prosperity. This forum is held back-to-back with the ASEAN+3 Finance and Central Bank Deputies meeting. In partnership with our co-organizer, the Hong Kong Monetary Authority and Bank for International Settlements, we are very delighted to host this year's forum here in Hong Kong, China. We extend our sincere appreciation to both institutions for their invaluable collaboration. And now it's my great honor to invite Mr. Eddie Yu, Chief Executive of the Hong Kong Monetary Authority, to come to the stage and deliver his opening remarks. Please welcome.
Good morning, friends and colleagues, ladies and gentlemen. First of all, welcome to the 4th AMRO Forum. And this is the first time that Hong Kong is hosting the forum, so a very special warm welcome to all of you who are here in Hong Kong in person, and also to those attending virtually around the globe. And the theme of this year's forum is Fragmentation to Resilience, and it speaks directly to the defining challenges of our time, including rising geoeconomic fragmentation, disrupted supply chains, and also emerging financial vulnerabilities. But even as the external environment becomes more challenging, ASEAN+3 members have demonstrated a remarkable capacity to withstand the shocks. Our region's economic growth has remained resilient despite the tariff shocks. Our financial markets have remained stable during recent episodes of global volatilities, and also our currencies have been stable for most of the time. This is a testament to the progress that we've made over the last few decades, including enhanced economic fundamentals, deeper local currency debt market, and also sound macro financial policies. Importantly, progress in domestic reform and policy development is complemented by achievements in regional collaboration and integration. For example, the effort to develop local currency debt market is supported by coordinated efforts such as the ABMI and also the EMEA Asian Bond Fund initiative. The vast majority of bonds issued in the region are now denominated in local currencies, making us much less vulnerable to external spillovers. More generally, according to the BIS, EM-Asia is more integrated than any other EME regions, which will act as a buffer against global fragmentation. But we cannot be complacent. While tariff-related uncertainties have stabilized somewhat, the broader risks from the real economy and financial markets persist. The region also faces structural changes like population aging, digitalization, or the rise of AI, which present both opportunities and also challenges. To handle these challenges, domestic policies and reforms are of course important, but deepening regional cooperation will also play a key role. And in my view, they include at least three areas. The first area is to deepen regional economic integration. A low-hanging fruit is trade digitalization, which can significantly streamline and make the trade process much more efficient, and that will empower SMEs to participate more fully in the regional value chains. In Hong Kong, we have launched a number of initiatives to make trade finance more efficient and also accessible, including improving digital trade finance through the use of cargo data under a project called Project Cargo X, and also leveraging innovative technology to tokenize the trade documents under Project Ensemble. Benefits from these initiatives can grow exponentially when more jurisdictions come on board. And we hope that jurisdictions that are here today will be able to join hands and work on those initiatives together. The second area is to expand the use of local currencies. While progress has been made, local currencies still play a relatively small role in the region's cross-border transactions and also external financing. And the bulk of our trade invoicing is now still not denominated in foreign currencies. We need to continue to enhance regional payment integration and local currency settlement to boost cross-border efficiency and to strengthen economic resilience. This requires continued investment in deepening the local capital markets, developing hedging instruments, and also ensuring financial infrastructure are interoperable across borders. At the HKMA, we've already connected our faster payment system with our counterparts in Thailand and also in Chinese mainland in recent years. And we've also developed a cross-border wholesale CBDC platform jointly with other central banks. Again, these are initiatives that we hope to take forward with our ASEAN+3 colleagues. The third area is to strengthen our regional financial safety net. The Chiang Mai initiative, of course, is a cornerstone of regional liquidity backstop. And ongoing efforts to further strengthen and broaden the CMIM will further complement the safety net. and enhance the mechanism's readiness and financial credibility to respond very quickly when potential liquidity pressures arise in the region. In all these endeavors, both AMRO and the BIS Asian Office play indispensable roles. AMRO's timely and high-quality macroeconomic surveillance enhances policy coordination among ASEAN+3 members and preparedness for external shocks. The BIS Asian Office serves as a regional hub that facilitates dialogue and cooperation among central banks in the region. The HKMA remains committed to strengthening our collaboration with both and to advance regional financial integration and resilience. Today's forum is a good example of that collaboration. I'm confident that the discussion today on macroeconomic risks, on the shifting global financial landscape, and also on the priorities for cooperation, these will generate valuable insights that will guide our collective actions in the region. I wish you all a very productive and enjoyable forum today. Thank you very much.
Thank you very much, Mr. Yu. We're truly honored by your presence today. Next, it is my pleasure to invite Mr. Tao Zhang, Chief Representative for Asia and the Pacific, Bank for International Settlements, to come to the stage and deliver his opening remarks. Please welcome.
Well, thank you. Good morning, ladies and gentlemen, colleagues and friends, and Watamadi-san and Eddie. It is my great pleasure to join all of you today, of course, to congratulate AMRO for the 4th AMRO Forum here in Hong Kong. On behalf of the BIS, let me begin by thanking AMRO and the Hong Kong Monetary Authority for inviting the BIS to co-host this year's forum. Indeed, this is our first time to join the forum as a co-host, and we are honored to see this as a deepening effort to our partnership with both AMRO and Hong Kong MA, and indeed, in the broader terms, to the Asian Central Bank and other authorities communities. I would also like to extend a warm welcome to all the participants joining us today, both in person and for those online. This forum, as we witnessed, has quickly become an important platform for collective dialogue in the Asia and the Pacific. It brings together policymakers, regulators, academics, market practitioners, and international organizations to exchange perspectives on the key macro financial issues facing the global economy and in particular the Asian economies. The fact that we are all gathered here today reflect our shared commitment to strengthening the region's resilience and during the period of the considerable global uncertainties. As Eddie and Watanabe-san just mentioned it, fragmentation is the theme of this year's forum. Indeed, while the global economic growth has remained steady, signs of moderations has begun to appear. This overall trend masks meaningful differences across economies, with some advanced and emerging economy maintaining firm momentum, while others are experiencing a gradual lose of pace. In Asia, economic activities has been broadly resilient even amid tough uncertainties and a more challenging external environment. These developments are unfolding alongside significant structural changes in the financial systems. The growing role of market-based finance and non-bank financial intermediaries has deepened cross-border financial linkages. It has also introduced new channels through which volatilities can spread. And across many jurisdictions, rapid digitalizations from instant payment systems to tokenized financial asset is transforming the way financial markets function. These innovations offer enormous potential benefits, but they are also requiring careful attention to governance, to operational resilience, and, of course, to financial stability. For Asian economies, the global and structural shift represents both risk and opportunities. The region has shown impressive resilience in the face of recent shocks, but maintaining and strengthening that resilience would require domestic policies, sound institutions, and crucially, close collaborations among economies. Indeed, collaborations among regional authorities, including central banks, is essential to manage cross-border spillovers. Collaborations between the public and private sectors is vital to ensure innovations develops safely and sustainably. Collaboration among international organizations, including AMRO, the BIS, and our other partners, enables information sharing, learning from each other's experience, and translation of the best practices into actions. So today's forum embodies this collaborative spirit. It provides a valuable opportunities to all of us to exchange insight, deepen common understanding, and collectively reflect on the region's policy priorities. So with that, let me thank you once again and wish the forum every success. Thank you.
Thank you very much, Mr. Zhang. Please kindly remain on stage for a group photo section. And now, may I invite Mr. Watanabe and Mr. Yu to come to the stage and join Mr. Zhang for this group photo, please? Please welcome. May I invite Mr. Watanabe to stand in the center? Mr. Zhang can stand. Thank you very much. Let's stand closer together. Look at our official camera and give a brighter smile. Let's kick off our program brightly. Let's give a thumbs up to our photographer. What a good morning. Thank you very much, everyone. Please be seated. Thank you so much. At this moment, we will move into the core of today's program. Whether you're here in person or joining us online, we hope you are ready for a day of deep insights and engaging dialogue. Today's forum will examine the near-term risk to macro financial stability in the region, as well as strategies to support long-term sustainable growth. Our program is structured in two sections, each featuring keynote speeches and panel discussions. We'll begin with session 1, macroeconomic risk and regional integration amid global fragmentation. We're very privileged to have two distinguished keynote speakers for this section. Our first speaker is Professor Hei-Wai Tang, Director of the Asia Global Institute, the University of Hong Kong, and Victor and William Fung Professor in Economics. He's a leading expert in international trade and global value chains. Professor Tang has held appointments at Johns Hopkins University, MIT, and Harvard, and he has consulted for major global institutions such as the World Bank, IMF, and Asian Development Bank. Ladies and gentlemen, let's join me to welcome Professor Tang.
Mr. Watanabe, Mr. Eddie Yu, Mr. Tao Zhang, ladies and gentlemen, distinguished guests, it's my great honor to be the first speaker of today's conference. I didn't know this is the first time that AMRO has this forum in Hong Kong, so this means a lot to me as a person who is born and raised in Hong Kong. And thank you very much to He Dong for inviting me to be one of the keynote speakers today. So I was told that I only have 15 minutes, so I'm going to be quick and efficient to talk about three things. So first, I'm going to spend a few minutes talking about the so-called deglobalization, and then I will quickly move on to talk about the so-called restructuring of global supply chains under the so-called Trump 1.0 era between 2016 and I would say all the way to 2024. And then towards the end, I'm going to talk about Trump 2.0, which started at the beginning of this year, and how supply chains and how global value chains have been restructured due to tariffs and all sort of geopolitical shocks. So let's start. So this a bit of delay. All right, so I'm going to start with this well-known picture that shows essentially the value of trade compared to the value of GDP in the world, and how this ratio has been changing in the last 150 years. I know this is a very timely conference and not supposed to talk about history, but I think some historical perspective is probably quite important for us to understand the current situation as well as the future. So that ratio has been rising rapidly since the end of the Second World War, and it hit the peak in 2008. When the financial crisis happened, that ratio has been declining very gradually. And of course, I'm measuring trade in a very simplistic way, which is to look at gross exports in manufactured and merchandise products. And during COVID, like many of you, I had too much free time, so therefore I started to read history books. But instead of wasting all my time to study world history, and I decided to read history books that are about globalization. And indeed, this is not the first time that we experience some sort of deglobalization, or you may want to call it globalization. Actually, before the First World War, we also had a similar phenomena that countries are putting tariffs and all sort of trade barriers against each other, leading to a slower growth in trade as compared to the global economy. And after reading 20 books, I decided to write a paper, and in 2020, the paper was out. It's called Globalization in Crisis. And I still remember when I wrote that paper, a lot of my friends in the US wrote me an email saying that, hey, why? You're too pessimistic. I think after COVID, things are going to improve significantly. This time is different. You should not compare 2020 with 1920, when the world was also deglobalizing. So the paper basically summarized the three necessary conditions for how global trade can improve and grow continuously. The first condition is actually how technologies are market integrating instead of decentralizing trade and decentralizing production. If you think about the steam engine in the previous century, or the internet towards the end of the previous century, both technologies are actually bringing countries and markets and people closer to each other. If you think about today's technology, which is all about AI, blockchain, and finance and trade decentralization, you may think that these disruptive technologies that we have today are not bringing markets closer to each other. They're actually allowing production and a lot of decision making to be a bit more decentralized. So that's the first necessary condition. The second one is well known. We are living in a world with quite a lot of geopolitical uncertainty. We do need the leading economic power to support multilateralism and multilateral organizations. It's sad to say that the leading economic powers, governments today, may not be putting so much effort to support some of the multilateral organizations that they created after the Second World War. And as a result, we are living in sort of a vacuum without a strong leader supporting multilateralism. The third necessary condition is that you need the favorable domestic environment, and that is people support globalization, which includes trade, but also migration. And it is true that a lot of countries are experiencing quite a lot of rising inequality, and therefore they may not think that trade and any kind of global activities are actually good for them. So it's sad to say that today we don't have any of the three necessary conditions, and therefore it is not surprising to see that trade as a ratio to GDP has not been rising since 2008. But I would like to say that perhaps we are looking at globalization from a wrong angle. In 21st century, we should measure trade in a more holistic and broader approach. If you include service trade, for example, things look a bit more optimistic. Service trade as a ratio of GDP is still rising, despite not as fast as before 2008, but this is the new kind of trade that we should try to measure and try to study and try to promote more. So Eddie just mentioned, Hong Kong is very eager to promote trade digitalization. So I think, in the next 5 to 10 years, we're going to see more digitized trade and more service trade instead of merchandise trade as compared to GDP. So that's the first part of my keynote. My second part is going to be more exciting because I'm going to talk about several research papers that try to assess the impact of Trump 1.0 tariffs and different kind of policies on the global economic situations. So this is another famous graph. Before 2024, you have the largest two economies putting tariffs on each other. Towards the end of 2024, both countries' governments are putting around, on average, 20% tariffs on their major trade partners. And as a result, in March 2018, when the Trump administration first proposed tariffs on China, I decided to write a paper. But it may be too early to get any kind of data to assess the situation. Luckily, I met a good friend of mine, Yi Huang, who is now a senior advisor to Zhang Tao at the BIS, as well as my good colleague right now, Chang Lin, who is a finance economist. So we decided to look at stock market prices and how they fluctuate around the announcement dates. The several famous announced dates are listed on the slide. So the results are not surprising. Firms listed on the US stock market or on the Chinese stock market, if they are more exposed to US-China trade, their stock prices tend to decline more around the dates when tariffs are announced either by the US government or the Chinese government. Moreover, people may think, well, this is just a short-term event study. Why are you saying that tariffs are bad for the global economy in the long run? To our surprise, when the paper got more matured and got rejected by several journals' editors, we actually got more data to measure sort of the medium-term impact. If you look at firms that are listed on both stock markets, after 3 months, they are still underperformed as compared to companies that are not so exposed to US-China trade. And later on, BIS economists, we also got access to a wonderful data set which allows us to measure essentially supply chains for the listed companies in both countries. Even if a company is not directly exposed to US-China trade, their upstream partners or downstream customers may be exposed to the tariffs, the shocks of the tariffs. So therefore, there are sort of indirect impacts that will spill over to all sort of companies in both China and the US. And the conclusion of this paper, which is finally published in the Journal of International Economics, by the way, one of the most cited papers published in that journal in the last 5 years, and we find that intuitively, companies that are more exposed to trade are more negatively affected by any kind of tariffs announcements. But more importantly, we learned something about the resilience of supply chains and the flexibility of how supply chains can be restructured. We learned that companies that invested more in R&D tend to be more resilient. This is true both in the US and China. On the other hand, if companies are buying more differentiated inputs from China, there's little room for them to find substitutes in other countries, such as Mexico or Vietnam. So therefore, the structure and also the characteristics of the supply chains can tell us a lot about how companies will be able to deal with tariffs and any kind of anti-trade policies. So that's my little paper, but later on there are a lot of more important papers published about how US tariffs are affecting the global trade. For example, this one written by Penny Goldberg, the former World Bank chief economist and co-authors, notice that there are winners and losers in the first era of the US-China trade war. For example, if you look at this graph, which essentially gives you the estimated positive impact of export from individual countries as a result of tariffs imposed by either US and China, there are actually quite a lot of winners. On the far right of this graph, you see Romania, Turkey, Vietnam, and Thailand basically experience an increase in export, not only to the US, but to the rest of the world. And later on, I also try to use some macro data instead of stock price data to look at how supply chains are being restructured. First of all, when you look at US customs data or Chinese customs data, you will realize that US is no longer the major destination for Chinese direct exports. In 2018, US accounted for close to 19% of China's total export. By the end of 2024, it's only down to 14.7%. Replacing the US is now ASEAN, the 10 economies in Southeast Asia. Obviously, ASEAN has not replaced the US as the final goods market yet because there has been something called China +1. So using global input-output tables put together by the Asian Development Bank, I was able to measure that before 2018, around 10% of China's exports is indirect. Indirect meaning that there are third parties helping Chinese companies to export goods to the Western market, in particular to US. But after 2020, this indirect trade ratio has increased to 25%, which means that 1/4 of China's exports to the US today is actually through third economies. And who are they? The usual suspects. Again, using input-output tables, I was able to tell Mexico, Vietnam, Taiwan, Canada, and Korea are the beneficiaries of China +1 strategies before 2024. And there's something related to this sort of supply chain restructuring, and that is FDI is also being restructured. Now you see a lot of Chinese companies going out, investing first in Southeast Asia, and now going to India, the Middle East, and even to Latin America. In 1960s, there's a famous economist in Japan called Akumasu. He wrote a paper defining this phenomena as the flying geese paradigm. And of course, he was talking about Japanese firms going out in the 60s all the way to the 90s. But today, we are talking about Chinese firms doing the same, investing in developing countries, but also bringing technologies, human capital, and even management practices to those countries. So, instead of saying that, Chinese exports lost a lot due to tariffs, it is actually a moment for Chinese companies to internationalize their supply chains and to be more connected to their trade partners, especially in the region. So I feel that I am running out of time. I see that I only have 2 minutes left, but I still have 15 slides. So I really have to be very strategic about what to say. On the Liberation Day this year, April 2nd, I was invited by the IMF to discuss 3 papers in their Asia conference in Japan. These are the 3 papers that I don't have time to discuss, but basically they all talk about how supply chains are being restructured. First of all, geopolitical shocks, tariffs will lead to less efficient supply chain management because now we are talking about diversification more, we are talking about resilience a lot more than efficiency. But things have not become so bad as compared to the previous Cold War 1.0. If you look at Cold War 1.0, when the US and the USSR are fighting or competing, we are talking about between bloc trade declined by 50%, as compared to within bloc trade. Today, at most, you see that between bloc trade, let's say, trade between US and China declined by around 10%, or, trade between US airlines and Chinese airlines declined by less than 5%, right? So in terms of the total amount of trade decline, it is still much less compared to what it has happened in the 60s and 70s. But the world is a lot more globalized, so even though the ratio is much smaller, the actual volume is much bigger in terms of trade destroyed during the Trump 1.0 era. So let me talk about Trump 2.0, which started at the beginning of this year. If I have 2 minutes, I want to go through a lot of slides, giving you some ideas about what has happened in the last 9 months. April 2nd, Liberation Days, a lot of tariffs being announced on over 100 trade partners with the US. Things have become a little bit more certain and stabilized, 90 days after April 2nd. And these are the new tariff rates on different countries. India is subject to 50%, Brazil as well. So, many countries are still, eager to negotiate with the US administration to try to lower the tariffs from 50% to a lower levels. If you ask me, after doing some research and talking to quite a lot of supply chain managers, I think the US government is ready to put around 20% on average to the rest of the world. Some countries probably will suffer a bit higher tariffs, like China, which still have around 50% US tariffs on average. But India, which currently has 50%, I think they will be able to lower that tariff to closer to 20%. If some countries are willing to offer more to the US government, a bigger discount, right, from 20 to 18 or to even 17% tariffs. So in sum, I think the worst has been over in terms of trade policy uncertainty. This is a graph that I got from the Financial Times. You see that any measure of economic policy uncertainty has increased at the first half of this year, but since August, it has declined quite a bit. Moreover, here we are talking about not just China plus one, but US plus one. Many countries are now trying to find destination markets that are outside of the US, which is still the largest consuming market. So, the first slide here shows you that we look at Chinese export composition. Final goods share in total China's export has been increasing a little bit. But what has increased most is actually capital goods export from China to the rest of the world, which is consistent with the flying geese paradigm, but also Chinese firms going out to find production facilities and trying to expand their supply chains. Moreover, not just Chinese companies, but companies around the world are trying to spread the supply chains more globally. So as a result, smaller companies, smaller open economies also benefit, this time as compared to the previous time, which is mostly about China plus one. Last but not least, there's a recent paper published by, leading economic journals. They also show that, Chinese companies, instead of selling more goods to developed nations, they started to lower the prices of the export and downgrade the quality of the goods and sell them in developing countries. So, openly, I have said that, the major solution to China's excess capacity, you may say, is actually China itself, right? They shouldn't rely on, all the foreign markets to absorb all the great and high quality but cheap goods. Because at some point, other countries are probably going to learn to do the same, which is to put anti-dumping duties or tariffs on Chinese exports as well. So my final slide is the following. I remain optimistic about global supply chains. I think, this time supply chains have been expanded more globally and become more inclusive. In Trump 1.0 era, from 2016 and 2024, companies like to talk about China plus one. Now they're talking about China plus one, but also US plus one. Goods are flowing to many new destinations. Supply chains are, expanded not only to Southeast Asia, but, different developing countries in the global south. But let us not forget that trade is a great stabilizer for not just the global economy, but for global peace. There's a famous saying in French, which is, if trade doesn't cross border, soldiers will cross border. It is true that with supply chains that have become more fragmented, climate change risks, as well as interstate conflict risk, have increased a bit more than 10 years ago. But luckily in this region, like AMRO, there have been quite a lot of discussions about finding regional solutions. like RCEP, which also has essentially the same members of AMRO, CPTPP, which is initiated now by the Japanese government, deeper digital economic partnership agreement, which was proposed by the Singaporean government. All these regional solutions and agreements may provide temporary solutions before we get to a more inclusive and more stable multilateral system again. So hopefully, I give you some optimism about the future, and hopefully give you some ideas to think about, how we should work together to create a more peaceful and more inclusive environment, not only for global trade, but also for global finance. Thank you very much.
Thank you very much, Professor Tang, for setting the tone for today's discussion and sharing your insight on the challenge and opportunities ahead of ASEAN+3. Our next speaker is Professor Barry Eichengreen, George C. Party and Helen N. Party Chair and Distinguished Professor at the University of California, Berkeley. He is a leading global economist and former senior policy advisor at the IMF. He is a fellow of major academies in the US and abroad, and a recipient of Guggenheim and Fulbright fellowships. On top of that, he's also led the influential Bellagio Group for 15 years. He'll be sharing his perspective through a pre-recorded video message with us. Ladies and gentlemen, let's hear from Professor.
Good morning, good afternoon, good evening, ladies and gentlemen. It's a pleasure to give this AMRO keynote today. You can see the title. It's about the Genius Act, stablecoins, and Asia. There are many interesting international monetary and financial things going on in the world at the moment. There are questions about the US dollar as the dominant global currency due to erratic US policies, soaring US debt, which I show you at the upper right of this slide. These are the Congressional Budget Office's projections of the US debt to GDP ratio going out to 2025, and you can see it goes up, up, up. There are questions deriving from weaponization of the dollar, increasing use by the United States of financial sanctions. You can see their incidence on the lower right, and they go up, up, and up as well. There are questions because of the fact that renminbi internationalization is slowing, and some would say stalling out. The renminbi's reserve share has been falling now for a couple of years. The currency is used mainly in China's own cross-border transactions. The share of the renminbi in payments through SWIFT has actually been falling. And by my calculations, the share of the renminbi in payments through SWIFT and China's own cross-border interbank payment system combined appear to be flat, and there is a reluctance on the part of banks in India and in the West to participate in CIPS. Their efforts to promote local currency settlement are bearing fruit very, very slowly. If at all, CLS is the main company that provides payment versus payment settlement services, but only for the Korean won, the Mexican peso, the South African rand in terms of emerging market currencies. China's own China foreign exchange trading system designed to provide payment versus payment settlement for the renminbi does so only for the Russian ruble and a few other currencies. So exchange rate risk, settlement risk for local currencies in Asia as well elsewhere remains problematic. And now there is the Genius Act passed by the US Congress and signed into law by President Trump this summer, one goal of which is to solidify the international role of the US dollar. How might the Genius Act do this? The underlying idea is that dollar-linked stablecoins will provide a faster and cheaper set of payments rails, not only for domestic transactions in the United States, but also for cross-border payments worldwide. It will be faster and less expensive than the correspondent banking system, and its messaging system, SWIFT. If this enhances the attractions of dollar payments, corporate treasurers around the world will be encouraged to maintain inventories of dollars, given their continued utility in transactions. Central banks likewise will be encouraged to hold reserves of dollars, since without them, they won't be able to act as, those central banks won't be able to act as dollar lenders and liquidity providers of last resort. So these complementarities between payments, between the activities, financial activities of corporate treasurers, the financial preferences of central banks will lock in dollar dominance. Geeta Gopinath and her co-authors have written extensively about these complementarities and the fact that some 99% of stablecoins worldwide are linked to the dollar at the moment supports this presumption that widespread adoption of this digital technology will be dollar positive. Let me review very briefly what the Genius Act entails. It authorizes issuance by banks, non-bank financial firms, and tech companies of dollar-linked stablecoins. It provides for multiple regulators of those issuers. So if they are subsidiaries of member banks of the Federal Reserve System, they will be regulated by the Fed. If they are non-member banks, tech platforms, big retailers like Walmart and Amazon, they will be regulated by the comptroller of the currency. And if they are state banks or smaller companies, they can be issued by state bank regulators, such as the very enthusiastic state bank regulator of the state of Wyoming. The Genius Act requires redemption on demand of dollar-linked stablecoins at par at a fixed value of 1-to-1. It requires the issuer to hold 100% backing in highly liquid, low-risk reserves, which in practice means bank deposits, short-term treasury securities, money market mutual funds, and what the Genius Act calls, quote, other similarly liquid assets. It requires monthly examination and annual audits of the balance sheets of those issuers by registered accounting firms, the annual audit being a more demanding process than light touch monthly examination. And it prohibits stablecoin issuers from paying interest to holders in order to limit flight from bank deposits toward stablecoins, although there may be a loophole there that the exchanges that on which stablecoins circulate and trade may be able to pay interest and obtain payments to enable them to do so from the issuer. This then creates challenges for governments and central banks in Asia, specifically and more generally continued dollar dominance enabled by dollar stablecoins mean continued exposure to U.S. policy uncertainty, U.S. debt problems, potential further weaponization of the dollar. There is the danger of currency substitution from local currencies to dollar-denominated stablecoins, and there is scope for money laundering, tax avoidance, capital control, evasion, all pointing to the question of how governments and central banks should respond to these dangers. So I will list 5 possible responses. Possible response number 1 is to do nothing, because stablecoins will not, in fact, enter the mainstream of cross-border payments. Stablecoins are not insured. Deposits with U.S. correspondent banks are insured up to a limit. Past experience suggests that stablecoins may not, in fact, be stable, that safe and liquid assets can quickly become unsafe and illiquid. This happened to Circle in 2023 when it held its backing at Silicon Valley Bank. There are questions about the singleness of money, about fungibility. Will Amazon coin be usable at Walmart? Will Walmart coin be usable at Amazon? And the correspondent banking system and SWIFT are not standing still. They are experimenting with Bitcoin and, I'm sorry, they are experimenting with blockchain and instantaneous messaging. Currency substitution may be a problem in some parts of the world, but not obviously in Asia, in emerging and developing Asia, where inflation rates are much lower than they are in Latin America or sub-Saharan Africa. Possible response number 2 is to attempt to ban dollar-linked stablecoins, following China, which banned crypto in 2021. Bangladesh has issued a similar ban. If I understand correctly, Indonesia and Vietnam do not prohibit residents from holding stablecoins, but they bar their use in payments. There are those examples, although few other Asian countries have followed them down this road. China has done this by attempting to block wallet services, restricting accounts on crypto exchanges, banning crypto advertising. But a recent study by the IMF using language, script, regional references to identify a wallet's location suggests significant stablecoin flows into China in 2024, enabled by the use of VPNs and so forth. Possible response number 3 is to issue competing local currency stablecoins. So Japan put in place a regulatory framework for yen-linked stablecoins in 2023. Singapore moved shortly thereafter, authorizing the licensing of Sing dollar stablecoins or stablecoins denominated in other major currencies. Other countries could follow, and the Hong Kong Stablecoins Ordinance of August of this year, providing for Hong Kong dollar denominated stablecoins, the expression that Alibaba and Bank of China, among others, have expressed in obtaining a license suggests that this may take off. The question is whether China is likely to bring this experiment back on shore. Its capital controls could be jeopardized if it adds China's digital ID system to renminbi-denominated stablecoins. Having to give up that information, confidentiality, will probably not be attractive to foreign counterparties. Possible response number 4 is to link fast payment systems in the region. These, of course, do not run on blockchain. They run on the same protocols as cross-border interbank payments. They're actually faster than stablecoins, which may take 5 to 10 minutes for the average user to on-ramp one fiat to a stablecoin and off-ramp that stablecoin to a different fiat. Transfer is in actual bank money, avoiding the Amazon coin, Walmart coin problem, and there are 20 such systems in operation or being piloted in Asia. Linking these fast payments systems requires agreement on protocols and standards. It took Singapore and Thailand 3 years to finalize their agreement. Project Nexus, which is a project of 5 Asian central banks, might streamline this process of agreement. We'll find out in mid-2027 if everything goes according to schedule. It seems like agreement on standards and protocols is easiest among neighbors. So I show you on the right here the different regional clusters of fast payment systems from a study by the European Central Bank. There is a cluster in East Asia where links are in existence or in process, but there's only one link between East Asia and the rest of the world, namely that with India. So this would seem in the first instance something that can be done at the regional level, not so easily globally. It can't substitute easily for the global dollar. And possible response number 5 is interoperable central bank digital currencies. So CBDCs are being piloted in the region. The PBOC is in the lead. They offer speed, safety, and finality, but take-up is slow. The ECNY is hardly used at all in China itself. So if the Chinese don't use it, how can it be used cross-border? It can be used cross-border if experiments like Project Enbridge come to fruition. So as you know, Project Enbridge involves 3 Asian monetary authorities and central banks, and now 2 central banks outside the region, the UAE and the Saudi Central Bank. It works, the code works. It was developed in the Digital Institute of the PBOC, and the Bank of China reported that by July of 2025, it had processed transactions totaling $1.4 billion worth, 80% of which were in renminbi. Problem being that this is a drop in the bucket compared to what SWIFT and the correspondent banking system clear on a daily basis. And moreover, political issues remain to be addressed. Will decisions be reached by majority voting as membership expands and agreement by consensus becomes impossible? Who decides who gets to join? Will Western countries like the US be willing to join what looks like a China-led system? So again, my suspicion is that this kind of project will work to facilitate payments in the region, but not globally. So to conclude, what do I recommend? Doing nothing is risky. That much seems clear. Attempting to ban the use by residents of dollar stablecoins would seem to be limited to countries like China, where the government has strong control of the internet and of financial transactions of all kinds. Under these circumstances, I would argue the prudent strategy is to diversify, to explore the development of a local currency stablecoin, to link fast payment systems to those of other countries, and to continue studying, piloting, and rolling out CBDCs. I interpret China as having recently taken a modest step in this direction. It had been emphasizing the ECNY and Project Enbridge up until now. It is now enabling the adoption of a framework for licensing stablecoins in Hong Kong. I think other countries should be thinking similar thoughts about pursuing a diverse strategy in response to the Genius Act. So I hope that's enough to get thoughts flowing, and I thank you very much for your attention.
Thank you, Professor Eichengreen, for an insightful perspective on stablecoin regulation and its impact in Asia. Our keynote speaker have laid a strong foundation for a discussion on macroeconomic risk and regional integration amid global fragmentation. And we will continue an in-depth discussion during the panel discussion after a short break. To our online audience, please feel free to take a short break, and please resume at 10:15 a.m. Hong Kong Standard Time. Thank you very much. Our distinguished panelists, comprising policymakers and private sector experts, will share their views on macroeconomic risk and regional integration amid global fragmentation. And after the opening statements, the moderator will lead the discussions. For virtual participants, please submit your question online. For Zoom viewers, please input into the Zoom chat. For YouTube viewers, please click the link in the description box. For China-based viewer, please input your questions in the NovaWeb Q&A box. And for our on-site participant, you may scan the QR code on your tables and also on the back of your ID badges. Thank you. And without further ado, please welcome our session moderator, Dr. Dong He, AMRO Chief Economist, to come to the stage. Let's put our hand together to welcome a moderator. And joining Dr. Dong He, we have our distinguished panelists. Please welcome Ms. Chatavan Sucharitaku, Chair, AMRO Advisory Panel. Mr. Masulisham Omar, Deputy Governor, Bank Negara, Malaysia. Ms. Johanna Chua, Managing Director, Head of Emerging Market Economics and Chief Asia Economist, Citigroup. And Mr. Hai Bin Ju, Executive Director, Hong Kong Monetary Authority. Welcome, everyone, and I will pass the stage to Dr. Dong He.
Thank you. Good morning, everybody. A very warm welcome to AMRO Forum. I'm extremely happy to be back in Hong Kong. This is really my home city. So I'm very happy to see so many old friends. And I promise you this will be a fantastic panel. We have Chantavan, we have Deputy Governor Sham, Johanna from Citigroup, and Hai Bin, of course, our very new Executive Director of Research at HKMA. I have been friends with them for decades. So this is really a very good reunion of old friends on the same panel. The theme of the panel is from fragmentation to resilience. We would focus the first part of the discussion a little bit more on the conjunctural side, on the resilience at the current conjuncture of the region. And then we will have some discussion on the longer term resilience. How do we achieve resilience going beyond the conjuncture? I will ask each panel to share some thoughts in the beginning for maximum 3 minutes. Then we'll have questions. I do hope that you will prepare your questions when the panels speak. We will leave enough time, I hope, for half an hour for us to have a very interactive discussion. Of course, as you know, that earlier in the year, we were very worried about the region because the region is a very open region. When the US administration had such uncertain policy stance, we were worried how the region might fare. And so far, of course, the region has been doing quite well. Both the IMF and the AMRO ourselves, we have upgraded the forecasts. So we have seen some resilience, but some people would say this is a fragile resilience. So I want to hear from the panel how much fragility you see in this resilience. And the second part of longer-term resilience, I think, as you can tell, the theme of the conference is how do we promote integration as a way to increase the resilience in the longer term. So how do we have stronger incentives? Some would say this is really a crisis that should not be wasted, given such a very large shocks coming from outside the region. Can we create enough incentives to take the momentum forward to have, in order to increase the resilience? So let's bring these two perspectives, both conjunctural and longer-term resilience into the discussion. So I will ask Deputy Governor Sham to start, and then Hai Bin and Chantavan, and then Johanna, finally from a market's perspective. Deputy Governor Sham, please.
Thank you, Dong. Thank you very much, and thank you to AMRO for giving me the opportunity to be on this panel. Dong, as you say, that almost 6 months after the Liberation Day, we have seen that many agencies, many forecasters out there have actually gradually revised upwards the global economic outlook for this year and also for next year. What we have seen throughout this period is that the region, including ASEAN, has been rather resilient. Growth has been holding up well. The inflation is under control, and we have also seen to manage to maintain stability in our foreign exchange markets. In this environment, what I would like to highlight what I call two major forces that are reshaping the global economic and financial landscape. The first is, we have heard earlier in the earlier talk, is this growing economic fragmentation. This is mainly policy-driven. After decades of globalization, trade liberalization, markets opening up, we have now been confronted with growing economic fragmentations, tariff, non-tariff barriers, and other form of trade restrictions and frictions. The important thing to note is that how these economic issues are intertwining with geopolitical considerations, national securities, and so on. And for this reason, I do believe that economic fragmentation will be with us for some time into the future. The other force that is going on is the AI revolution. We have seen for the past decades how technological advancement has been very, very rapid. We saw the internet in the late 90s, mobile phones, cloud, and now the AI revolution. I do believe that a lot of people out there believe that there is a real demand for this, and how, moving forward, the adoption of AI would help to increase our productivity, efficiency, and so on. Of course, recently there's been some concern on the stress evaluation in the investment and the prices of the AI companies. So taking these two forces together, as I mentioned, it will have long-term wide implications on the region. And we have seen this. For example, in the case of Malaysia, we have seen that how the strong growth in AI has been translated into our strong export in E&E, semiconductors, as well as the growth in data centers. For central banks in the region, Dong and colleagues, our particular focus, I do believe, is to, in fact, under this environment of uncertain, high policy uncertainty, under this environment of high market volatility, the main focus of many of us central banks in the region is to preserve stability, enhance resilience. When we look at it, growth has been rather well in the region, and inflation has been moderate. And the moderate inflation actually allow some of us to recalibrate our monetary policy to support growth in an environment of price stability. Beyond that, as I mentioned, is the need for us, given the high volatility and uncertainty, is to preserve the stability in the financial markets, in particular the foreign exchange market. This is where having the necessary policy tools and wide range of policy tools for us to preserve this stability is important. And the third for us in preserving stability and enhancing resilience is to strengthen our external resilience, to build buffers where appropriate, either in terms of our international reserve, and importantly is to continue to preserve the strong and the healthy financial sector that we have to all the reforms that we have undertaken. Beyond the short-term weathering this uncertainty, of course, the focus of many of us is to facilitate the structural reforms that many of our countries are going through. Speaking about Malaysia, is that the government has undertaken a number of reforms which actually strengthen the economic and the productive capacity of the economy. In particular, is strengthening our fiscal position, and thus provide us the fiscal space to weather the period ahead. All in all, I would say that for us in the region, preserving stability, enhancing resilience will be immediate focus to us to weather this highly uncertain and potentially volatile environment moving forward. Thank you.
Thank you, DG Sham, for that central bank perspective. So let me move on to Hai Bin, who sits really in the International Financial Center here in Hong Kong. So how do you interpret the resilience we have seen so far?
Yeah, Dong, thanks for inviting me here to this event. Hong Kong is in a unique position as an international financial center and also the super connector between mainland China and the rest of the world. Of course, that Hong Kong is always taking the front row seat to observe these external challenge and also the rippling effects. But to be fair, I'll say, like you show at the beginning of the video, there's many challenges facing Asia this year. We talk about the geopolitical tension and fragmentation, talk about the U.S. trade policy uncertainty, and of course also the AI boom, of course transformative but also disruptive, right, for the economy, and also climate risk. We can talk about this later. So facing this challenge, remember at a certain time, particularly after Liberation Day, both from the public sector and private sector downgrade the growth forecast regionally and globally. But then we see actually the economic performance is much more resilient than we initially thought. And you talk about the recent upper revision across the region. For Hong Kong, of course, we know that the government recently revised up the GDP forecast for this year to 3.2%, previously 2 to 3%. And also financial market across the region is doing very well. So the question is that what attribute to this resilience? And if we look at the breakdown of the GDP performance, I would say the most remarkable part in my view is that the resilience in the trade exports, particularly for Asia. It didn't actually decline as we initially worried. So the question is that why? What contribute to this resilience in exports? I can think about the three key drivers that explain the resilience so far. The first one is that there's a process actually for the U.S. tariff shock to gradually unfolding, and we're still in the middle. So particularly if you look at the dynamics at the beginning of this year, particularly first half, there's a lot of export front loading contributed to the export performance, strong export performance in the region. And second is also is a tech cycle. We talk about AI, but there's a related AI boom. And as a major, the tech provider supply chain actually globally, Asia has a big keen beneficiary of this round of the tech cycle, particularly some the tech-related economies doing extremely well in the export in the tech-related sectors. The third one, I think probably most important is we see the diversification efforts in the trade activity start to pay off. And this actually, we're not talking about starting from this year. Actually, the process started actually a few years ago, right? But if you look at the export performance, actually, a lot of it coming from not export to the U.S., but coming from export to the rest of the world. Taking Hong Kong, for example, actually, Hong Kong's export to ASEAN actually is increased, and then more than offset decline to the U.S. So I think this is important, and that brings to my key message here is that the increasing integration in economic and financial market actually across the region, that attribute to the resilience of the Asian economy. And there's still a lot of room to further enhance this interconnectivity. And I do see actually there's still a lot of room actually to move in that direction. For example, a recent study show actually, if you look at the ASEAN economy, the intra-region trade is now in 20%. But if you compare to ASEAN+3, it accounted for 43%. So at least for ASEAN economy, I see the big room for further trade integration, right? And Hong Kong as the international financial center and also super connector role, I'll say there's a lot of room for Hong Kong to play to bridge actually in this new procedure.
Thank you, Habib, for this initial perspective from the International Financial Center. So let me come to Chang Tavan. Chang Tavan was Deputy Governor of Bank of Thailand and a very seasoned central banker in the region. And maybe you want to bring a longer-term perspective in terms of this, the challenges you see at the moment. Thank you, Chang Tavan.
I think you wanted to ask me something about the architecture of regional cooperation as we discussed, and what Haibin was saying, that there is room for further integration given the low base we're starting from ASEAN. By way of background, I've always looked at our ASEAN+3 cooperation as a finance and central bank cooperation. And this wave of fragmentation is more of the real economy, manufacturing, trade, investment, technology. So we have to be creative, innovative in looking for angles to support the integration. Of course, as a regional financial safety net, we are always there for our members in case of emergencies. But the development angle, I think, will be an interesting role that we could discuss further. And in drawing inspiration of what finance and central banks can do to promote the real economy, I looked back in 2008. Of course, 2008 was a global financial crisis. And for many of us, including myself, I don't know very much about G20. But you know, the whole world changed after 2008 with G20 mandating counterparty risk, complex financial instruments, and so many other reforms in the regulatory aspects. Of course, we're not in a crisis here in Asia, but what I meant is that the kind of cooperation that finance and central banks can do covers areas of regulatory reform. And I think where I'm leading to is that, of course, we are not major regulator in the real sector, but through our regulation of the finance activities and probably through moral suasion of our colleagues in the trade areas, maybe there are room to also open up and integrate further. So let me start with this for the first round. Thank you.
Right. I'm sure we'll come back to some of the points you have made, which are extremely important. Let me come to Johanna. So how do you see, how do you feel about the moment?
Yeah, so first of all, thank you. I'm very honored to be here on this esteemed panel. So absolutely, as you said, I mean, East Asia's growth ended up being a lot more resilient than we expected. If I look at Citi's latest East Asia forecast relative to where we were in April, or even if we compare it to IMF WEO back in April, it's a full 1 percentage point higher. And if you look across East Asia, the biggest delta where we saw big upgrades are like Vietnam, Taiwan, Singapore, and actually the one standout that actually growth is weaker than April is Philippines, which really tells you that you can have very sound macro policies, but institutions really matter. And we can all talk about why this has been very resilient. And pretty much, I mean, Haibin already mentioned these issues. I mean, obviously one is, I guess, the adaptability and the flexibility of the private sector in terms of preparing and reshuffling trade and production to mitigate some of the worst effects of the productivity shock from fragmentation. And a lot of ASEAN countries, Vietnam, one of them, are actually acting as these connector economies. So that obviously has been important. There's obviously a cost to it, but at least maybe the costs have been for now managed. But the second thing that I think is very underappreciated is, technological disruption can create secular demand trends that have nothing to do with tariffs, that are insensitive. I mean, Haibin mentioned the most important one for East Asia, which is AI, an AI capex boom, which not only drove demand for high-end chips, servers, and equipment, but just the whole creation of inference, creating a kind of exponential demand for data, also created a massive shortage of memory and memory chips. So there was a huge eco-cycle on AI. Now, the question is, for us economists, it's so hard to distinguish what is front-loading that's related to, what is tech demand that's front-loading, what is AI. It's really hard to disentangle. So we cannot take it for granted that will just continue on going into next year. And obviously, a kind of a mini tech trend that was also happening that was benefiting China was this whole clean tech, renewable energy. Now, I think going forward, we all talk about the importance of regional integration and intra-Asia trade. And indeed, it did rise, in recent years. And, there was Huawei talked about, globalization. But actually, East Asia, ex-China goods intensity actually rose. It's been rising. But I think the problem is when you look at intra-Asia trade, it's really mostly China and the rest of Asia, like China, ASEAN. If you look at just intra-ASEAN trade, there's nothing really there. So a lot of really is that this whole trade link with China, and some of that is related to connecting in the rest of the world. Now, the challenge, I think, going forward and why we cannot rest our laurels is I think there's still lingering challenges with the fact that even though growth is holding up,
First of all, we don't know what the AI cycle is going to look like, the non-AI part. There's still this unbalanced growth structure in China, and we still need to look at the growth, this distributional implication of growth in Asia, East Asia. I do worry about the K-shaped recovery, the unevenness of the recovery. And East Asia, we talk a lot about macro stability, and East Asia is really great at macro stability. But macro stability is a necessary but not a sufficient condition for growth. And for some middle to lower income economies, they really need growth. And I do worry that the quality of policy making, which has been so good, could be undermined and eroded over time if we're not addressing some of these kind of inequalities, and that we're still trying to grapple with, and that will be even more challenging in a world of fragmentation.
All right, thank you. Very, very helpful initiative, initial perspectives. But let me in a way, ask Johanna a follow-up question, and then I will go to Haibin. Because when I think about the impact of tariffs, of course, we have both the direct and indirect impacts. The direct one is that if tariffs lead to higher prices, then the demand for the export would decline. But the indirect impact, of course, is that it has impact on the larger economy. If the U.S. economy itself is going to be affected, that would have the second round effect. So far, the U.S. economy has been holding up reasonably well. So what's happening actually here, Johanna? I mean, one question is that, is the U.S. managing to extract through this very tough negotiations, through its position, some kind of terms of trade gain, or what's happening on the price side? So why is it that we are, we haven't seen a large hit on the exports?
I mean, some of it, Haibin alluded to it as well. There are lags to the transmission of some of these policy shocks. Maybe we also underestimated that a lot of corporates, obviously their ability of their margin to absorb some of the tariff impact. I mean, let's not forget, we don't only have a tariff shock, but we also have, in a way, kind of the China shock happening with this excess capacity that is also causing input prices to be relatively low. So maybe there's an absorption capacity at the margin. But I have to not underestimate the fact that AI is such a powerful force that's also, it's confounding, the macroeconomic. It's not that to say that tariff doesn't have an impact. I think Trump has been very, very lucky this year. But I think the AI CapEx cycle, and it's not just the direct impact on activity via CapEx, but there's a lot of indirect activity through the wealth effects. And as you know, in the US, the top 10% of household income already basically account for 50% of consumption. 20% is 2/3. So again, there's a lot of these things that are kind of confounding it. But our assessment is, because of this unevenness and unequal, you're starting to see already some impact on the labor market and the slowdown in the labor market. So we are expecting it to slow down going into next year. But I have to say, the AI part and trying to understand the nature and the capex cycle is really quite hard to understand for us economists.
Okay, thank you. So Haibin, from I think another way to think about why the U.S. economy is holding up very well, and that has implications for the export performance of this region as well, is financial conditions. Of course, the U.S., in a way, financial conditions have been really quite easy. Equity prices have been going up as part of the AI boom. But even when you think about where the treasury yield is, inflation has been sort of sticky at around 3%. So financial conditions have been quite easy. And what's the implications of the financial conditions, for example, for capital flows in this region? Hong Kong has seen pretty good equity market performance, +3 in general. Korea, stock market has gone up tremendously. So financial conditions in general globally have been quite easy. I think that's an important factor, offsetting the impact of tariffs. How do you see that?
Yeah, I see both from actually both domestic and the global. So from global perspective, just to add on Johanna's comment, that why U.S. economy is resilient. AI boom, of course, investment related. That's one key factor. But if you look at the U.S. consumption has also been holding up, and that I would say mainly because the wealth effect from the very solid stock market performance. If you look at of course, the one reason is that if you look at the U.S., there's a seemingly dilemma, right, between the inflation dynamics and the labor market condition. But so far, also, inflation has been picking up less than initially feared. So that's why it allowed the Fed to focus more on the labor market. They start to cut again, and we expect more cut will follow. And so, reflecting that, you see the dollars this year is on the weak side, the financial condition easing. So that for most Asian economies actually is a good news. And the second, on the domestic front, I'll say for Asian economies, also blessing that inflation is well under control. Of course, there's a discussion about China export deflation pressure to the rest of the Asia, but this is probably one of the factors. But overall, if you look at the inflation dynamics, most country inflation is within target. So that allowed many of them to able to use a monetary policy rate cut actually to address the external challenge.
All right. Okay, very helpful. Thank you. So let me move on a little bit towards the idea of promoting integration as a way to promote longer-term resilience. So Chantavan, as I mentioned, you really have seen it all in the region, various efforts that policymakers have taken in the past 20 years to increase resilience through integration. How do you see the momentum this round? In the sense that, you know, there's such a big shock that's hitting the region. And of course, in October, ASEAN+3 leaders and President Trump himself all went to KL, and we had this summit there. How do you see the momentum towards integration? Should we be realistic in terms of in thinking of how fast we can move? I'll come, ask Chantavan to start, and then I will ask Deputy Governor Sham to share some thoughts as well.
Because as the host of ASEAN, he was just fresh out of the meeting rooms. But from an outsider, I think this is probably the time for us to move forward with a renewed impetus. In the sense that because of fragmentation, we're seeing firms being scattered all over. But what will be the ecosystem for those firms to be able to really benefit from a seamless market of 13 or 14 economies that we are today? So design is done in one country, clinical testing is done in another, packaging, production, all these micro production activities needs to be supported. And we as finance cooperation has a room to help. We already have the capital market initiatives to help the funding side, but maybe the basic banking services is one area where we could discuss among ourselves and how we can support that. But I'm sure DG Sham has many views on how far we have come, given that AMRO has recently done a paper and submit to the ASEAN Summit on the ASEAN integration. For my part, I see the role of finance as supporting that integration further. Some basic issues on the ground, like if an SME from Singapore wanted to invest in Thailand, the Thai banks have no idea, have no track record of that company in Thailand because it's never been operated. So what does the home country regulator do, or home country bank can do? Typically in bank financing is the LC trading, referral business. But if we were to help our firms and business really integrate in our market, maybe there is a broader approach that we as finance officials can really help. I know the business advisory councils within ASEAN has also some proposals for our regulators, and maybe it's some areas in those basic building blocks that would help our firms and business expand within the region. So yes.
Right. So thank you, Chantavan. I think as you mentioned, that finance would play a very important role. But if we think about the history of European Union, the integration project, they started really on the goods side, right? So the common market took some years to form. Important progress has been made. But on the financial side, it's taken much longer. The banking union is still work in progress, and the capital markets union has been a subject for many years. I will ask the panelists to share some thoughts whether ASEAN and ASEAN+3 can see more progress in financial integration. I think Chantavan, you also mentioned the ASEAN integration report we have done. We are going to make that public later. But at the moment, I think it's very consistent with what Johanna was saying, that if you look at ASEAN+3, the intra-regional trade is more than 40%, whereas within ASEAN itself, it's still hovering around like 20-22%. So, DG Sham, from your perspective, how do we make some progress here? Because ASEAN really now has zero tariffs, really, among each other. We have achieved, this is quite an achievement, I would say, right? We should acknowledge progress, and credit should be given when it is due. So tariff is almost zero, but there are still some non-tariff barriers. And how do we take the momentum forward in your view?
Okay, that's a tough question. Everyone is grappling on that. Before I go on to regional cooperation, maybe I just to add a bit more in terms of our earlier discussion on the regional resilience. Drawing from Malaysia's experience, I do agree that the easing global financial conditions, the AI investment have certainly been positive for the region. For Malaysia, for example, initially we thought that after the the front-loading activities would slow down, our export would actually be affected somewhat. But we didn't see that. For example, in September and in October, our export of E&E continued to be very, very strong. 20% in September and almost 26% in October. And interestingly, this has been really supported by the strong demand for semiconductors, chips, and so on. And secondly, I think in Malaysia is also the diversification, not only in terms of our export product, but also our export market. We have seen, in fact, that our export to the United States has slowed down considerably. But this has totally been offset by our export to China, to East Asia, to ASEAN, which made up for the slowdown in our export to the United States. And another common feature for the region and for Malaysia is the strength of our domestic demand. I think this is important. And when we talk about regional cooperation later on, this is where there is a scope for the region, for ASEAN in particular, to look at and try to revive and support our domestic demand. And from there, we would be able to accelerate the intra-regional trade. Having said that about the economic resilience, I think moving forward is clearly, given the geo-economic fragmentation, which will most likely stay with us for some time, it is imperative, I think, that the region become more closer and collaborate and strengthen our integration and cooperation. And you mentioned about the experience of the EU. And in ASEAN, that for the past almost 3-4 decades, a lot of attention has been given on addressing barriers to trade. And likely, almost now all the trade in goods in ASEAN is subject to 0% tariff. And subsequently, ASEAN moved on to services, to investment, and recently also to digital trade, which is another new area for integration as well. But despite this, you alluded to the work by the paper by AMRO, which is a very good paper, by the way. that clearly intra-ASEAN trade has actually plateaued around 23%, or no, 22% of intra-regional trade. And then when we look at the foreign direct investment, intra-ASEAN investment has again, in fact, has declined. And today is only about 10% of investment within ASEAN is within ASEAN, the source of foreign direct investment in ASEAN. But the potential is there. ASEAN is made up of 700 million people, of a $4 trillion economy, and one estimate put it by 2027, this will reach 4.7 trillion. ASEAN could become the 5th largest economy in the world. So the question is, how could we, benefit from this? And how could we accelerate intra-regional trade and economic cooperation? From the financial integration perspective, we always believe that financial integration is essential as a way to promote greater trade and investment within the region. And towards this end, the central banks and finance ministries have been working on, among a few, in a few areas. The first is, it has been alluded earlier, even by Eddie in his speech, is promoting cross-border payment linkages. We have made a lot of significant progress, and under our chairmanship, one of our priority economic deliverables is to speed up and accelerate this. Today, we have 26 live cross-border payment connectivity. And almost 50 million merchants, for example, throughout ASEAN, have actually have the capability to accept cross-border QR payment. In Malaysia, almost 3 million merchants accepted this. And this benefit tremendously the small and medium enterprises and facilitate greater tourism activities as well. Another important initiative within ASEAN is the local currency settlement framework, where we actually encourage trade to be settled in local currencies. For Malaysia, for example, our trade with China, our trade with Indonesia, our trade with Thailand now are possible to be settled in local currencies. 10%, almost 10% of our Malaysia's trade today are settled in local currencies. 28% of our trade with China are settled in local currencies. So these are examples of regional financial integration that central banks are focusing our effort to facilitate as a way to support greater regional trade and investment. And I think moving forward, there are a few other areas that we are exploring and to make sure that the region come closer and to make use of this opportunity to really strengthen how do we work together, how do we facilitate greater trade and investment in the region. I'll stop there and can elaborate later on. Thanks.
Thank you, DJ Sham. I think the digital payments area is a perfect example, I think, of how ASEAN can actually move quickly towards more integrated networks. I think ASEAN+3 in general leads the world in digitalization. And of course, digital payments connectivity really has advanced to such a stage that that's really, I think the region should be very, very proud of. I will press a little bit, maybe Haibin and DJ Sham and Chantavan. I ask you, if you want to, I really think about in the next 3 to 5 years, what initiatives can be taken in a very concrete manner that could materially facilitate further integration in the region? Do you see any specific areas? So maybe Haibin start, and then Chantavan, and then Deputy Governor Sham, and finally I will come to Johanna.
Yes, so we talk a lot about trade and financial integration, but so I want to deviate the topic a little bit. But one issue actually you brought up at the beginning is climate risk. I think it's for Asia, there's one area that you can promote the collaboration going forward, because the climate risk is crucial for Asia. Right? If you look at the weather, global temperature is now 2024 was the hottest in record. The temperature is 1.5 degree higher than the pre-industry level. For Hong Kong, this year we also that there's twice actually issued the number 10 typhoon, right? 12 times actually weather alarming. So I think for this area, the climate risk and the implication on economic activity actually turns out is an important issue. So now, related to these, the potential, I see two directions we can promote collaboration. One is that in the region, China is now, everybody talking about the China oversupply, right? China oversupply in the solar PV. But I see that if you see from the alternative perspective, this could provide opportunity for the region actually to accelerate the transition toward clean energy, right? Taking advantage of China's capacity. So that's one area. But in Hong Kong, I would say, sitting as a financial center, the second area is a financial service for the green transition. And if you look at the recent study by the IMF, IMF estimated that the potential green investment in Asia could reach $1.1 trillion every year. But this actually, the reality is way short of this number. So in Hong Kong, actually, HKMA has been doing a lot of efforts to promoting this the green and sustainable debt. Last year, actually, 2024, the issuance was more than $84 billion, and that's actually an increase of more than 60% increase compared to the previous year. And this year, if you look at the first half number, another 15% increase. So I think that Hong Kong as a financial center has been promoting this the financing support for the green transition. Of course, it doesn't stay within Hong Kong. So Hong Kong is also promoting the regional coordination, for example, collaboration with some the international organizations like FC, ADB, AIB to promote this the green. And also, I was in KL actually in June. I noticed that this year's ASEAN, the summit, the theme is inclusivity and also sustainability. So I think that good news is that the green and sustainability is still a word we talk a lot in Asia, not like in some other country, no longer is the key word. So I see that the green transition, to address the climate risk, that's also one potential area we can push forward as a priority in the coming years.
Thank you, Haibin, for bringing the green transition perspective. Actually, another bright spot in ASEAN integration, other than the digital payments connectivity that DG Sham mentioned, is ASEAN Power Grid. If you have not heard about it, that's another bright spot. So ASEAN countries are seriously thinking about how to integrate the power grid, particularly making use of the green resources in the Mekong River area, for example, Laos, and using technology from countries like Singapore and others, and integrate the ASEAN power grid. That's a very powerful initiative that's well underway that would facilitate green transition as well. So thank you for bringing that perspective. Chantavan, if I can ask you whether you have any one or two specific ideas you think that ASEAN policymakers should focus on in furthering regional integration.
I would play on the theme of investment, either in green or in technology, AI, and upgrading our skills and people. We were looking at trade figures that were not growing much, but the services sector has exponentially grown. And I think service cannot be delivered cross-border in the way that trade in goods does. It requires setting up operations in another country. And that's where investment will come into play to be able to deliver some of the services. The investment regimes in our respective economies may have moved a little slower compared to the trade because it involves regulatory barriers. and especially the non-trade ones. If you look at the recent UNCTAD report, the 2025 investment report, there are three elements of investment promotion. Typically, countries like us will go for incentives. So we give tax rebates for investment, but there will be limits to our fiscal resources. But the more powerful investment promotion, other than the fiscal resources, will be the liberalization part and the trade and investment facilitation, which the World Bank used to call it ease of doing business, but they now call it be ready. So those two parts are underutilized somewhat, at least in my part of the world, the liberalization and the trade and investment facilitation, which the private sector really have been asking for throughout our dialogues with the business community and the finance officials. So maybe listening to them and helping to collectively bring down some of those barriers will go a long way in helping to promote investment, both in the green and the AI and the technology aspects.
Right, thank you, Chantavan. Very important point. Deputy Governor Sham, any specific ideas in your mind you could share with us?
Thank you, Dong. Thank you. Before I go to that, I think in terms of payment connectivity, one project that we are very, very excited about is Project Nexus, where a number of central banks in the region are getting together to create a single platform that would link all these cross-border instant payment that we have currently. In terms of the priorities, I would like to touch on two things. One is that in terms of how can we work together to turn the high savings in the region to and direct it for productive investment. When we look at it at the region, in terms of, for example, within ASEAN+3, there are savings of clearly in the pension funds alone, they are close to $4.4 trillion in the region. At the same time, ASEAN in particular, the financing need is huge. Infrastructure alone, Asian Development Bank estimate that for the next, until 2030, the requirement for infrastructure financing alone in ASEAN alone could reach almost $3.1 trillion. The key is that we have the financial resources within the region. So how do we put the necessary financial infrastructure to actually direct the savings to meet the productive investment requirement within the region? And under the Malaysia ASEAN Chairmanship this year, we focus on putting together financing for ASEAN power grid that you mentioned about. And we have managed to bring in about 15 key investors who have committed almost US dollar 13 billion to help fund this. I think that the key is that, again, in terms of how can we work together to mobilize savings within the region to meet the financing needs that is huge in the region. The second priority, I would say, is to build and to further strengthen our regional financial safety net, CMIM. It took us almost 10 years to turn the bilateral CMI swap to CMIM in 2009-2010. It took us another 4 years to double the size of CMIM to where it is now, 240 billion US dollar. It took us another close to 10 years to actually approve the RFF, Rapid Financing Facility. Moving forward, we can continue to expect that markets would remain volatile, the region would face liquidity pressure, I think, coming from the more volatile and highly uncertain global environment. So it is very, very important for us as a region to make sure that we have a workable regional financial safety net. And that is why I think for the past 2 years, we have been working very hard to transition the CMRM into a paid-in capital, which will provide, I think, a certainty and dedicated funding for members which need liquidity needs during the stress period. So I would think that the strengthening CMRM, strengthening the regional financial safety net as a key priority for the finance and central bank officials for the region to work on collectively, which actually would help us as a region become not only more resilient, but as well as together we can protect and preserve the strength of the region. Thanks.
Thank you very much. So now I'm going to take questions from the floor. We have already collected quite a few. We still have 40 minutes. So if you have questions, please do send them. And I'm sure it will be a very interesting interactive discussion. Now, the first couple of questions are more on the conjunctural side. So I would probably ask Johanna and Haibin to share some thoughts on this one. First of all, do you see that the monetary policy easing cycle in Asia would pause in 2026? Is there a risk for regional economies, or do you actually are you anticipating a slower 2026 for Asia? Or do you think there are actually upsides that we are not seeing yet, or people are not emphasizing enough?
Yeah, so thank you very much, Dong He. I think the overall theme for Asia central bank easing is we're pretty much on the last inning already. We're almost over. Maybe there's a few more with a little bit of residual cuts like Philippines, maybe Indonesia. But by and far, inflation has been very well behaved here. For most of East Asia, not only is inflation around target, some of them are actually undershooting targets. But I think the main reason why we think we're topping out, we're stalling now, is for three reasons. I think number one, there's a huge premium in this, we're so conservative as a region. So there's a huge premium to policy buffer. And so unless growth really has a new demand shock, you want to preserve your space. The second reason why I think policy space is kind of hit, monetary policy is at the end, is that in even some economies like, where you have very low inflation undershooting like China or Thailand with still high ex-ante real rates, the problem is nominal rates are getting close to the perceived lower bound. And the lower bound is well above zero for many other reasons. So that's the other reason. And obviously, this is particularly unique for Korea. There's a financial stability kind of constraint a little bit with housing market. And then lastly, I guess in the case of Indonesia, rupiah stability, there's a huge premium. So with the narrow rate differential with the Fed, so pretty much I think we're done. Now, having said that, we also think inflation has already bottomed, just from a headline. But a lot of it is base effect. By and large, I don't really see a lot of reflationary impulse. I'm not really, even if headline goes up a lot, we're not envisioning at this juncture a major oil shock. I mean, oil prices were kind of benign. We're not seeing any major kind of food-related shocks at this juncture. So I do think we're kind of done. Now, the question is, part of that is we are expecting a growth slowdown next year as a whole, partly because it's been so good this year. So there's a little bit of base effect. And as I said, there are still some lingering challenges in kind of the unbalanced nature of growth that will continue to provide a drag for next year. But I just think, I don't think growth is bad enough to see another wave of significant easing at this point, barring any shocks.
Haibin, any upside you see?
Well, I genuinely agree with Johanna said. I think that for the region, that in January, growth will slow down a little bit, not by too much, right? And the room for further rate cut is probably more modest. And of course, in the region, it's still diverse. Japan is a big exception, right, in the region. But the reason for the modest slowdown story, I think that although that this year that the economy, the performance, particularly trade has been very resilient, but the trade risk is not going away. I explained actually some resilience, the export performance, but if you look at the US side, number one, the US tariff impact on the activity, particularly for the region, say, if you look at the greenfield investment, actually since late 2024, the new longer-term greenfield investment growth has been slowed down quite a lot because the lingering trade uncertainty. And the U.S. tariff, if you look at the market calculation from 2.2 to 3% at the beginning of the year, already increased to close to 20%. But if you look at the the tariff collection data calculate the average effective tariff rate now is only slightly over 10%. So there's still a significant gap. And part of the reason is because of the delay, the gap in the implementation, but also some temporary adjustment in the import structure from US side. Higher tariff goods actually import less in the near term. So the point is that the tariff impact is still unfolding. That's why actually from the tariff impact perspective, I would say in the next few quarters, we're going to still see the impact. And also the tariff uncertainty is still there. Good news is that after KO meeting, the US-China actually agree on the truce, and but nobody is clear say how sustainable it is, right? And also that don't forget this, the Supreme Court has the public hearing on the IEEPA tariff implementation. I would just say that the general opinion is that it increased the odds of the reversal of the IEEPA tariff. And right now, the market general belief is that even if IEEPA tariff is revoked, it doesn't mean actually U.S. tariff level will be reduced because President Trump has in hand many other instruments, right? The Section 122, 232, 301 to keep the tariff level relatively stable. But this will generate this volatility because it involves the rebate of the refund of the tariff collected under IEEPA and then the imposition of the new tariff, which has a different feature. So I think this is uncertainty still we need to worry. And lastly, for Asia, particularly, I would say there's still the lingering uncertainty about the transshipment tariff. So far, we haven't seen any details. But transshipment tariff is particularly important for the tech sectors. And we know that in Asia, the value-added term, actually, the value-added components actually is particularly vulnerable for the tech sectors.
Right, okay. So thank you for those perspectives. Actually, in AMRO, what we feel, one potential upside could be stronger private investment in the region next year. Because so far we have seen that FDI applications into the region have been growing very fast, in the range of 20–30%. There are many applications, relating to AI, related, data centers. So if these applications become materialized, then I think we are going to see stronger private investment in the region next year. So that could be could be a potential upside. So there are a couple of questions on the rationale for integration. So I will ask DG Sham and Changtavan to maybe share some thoughts. The questions are really, we seem to be assuming that integration is the way to go, and that's going to increase resilience. And some questions are actually questioning that. Questioning, do we really need to see more integration? Aren't we going to increase vulnerabilities by being more integrated? So how do we strike the balance between integrated to some extent, but not too integrated, too overexposed? So that's the essence of some of these questions. I don't know whether or Johanna, you have some thoughts.
Yeah, no,
already.
absolutely. Look, I'm thinking of it from the lens of development economics, right? I think what really generates kind of growth acceleration, per capita income convergence is access to a larger market and then the associated technology transfers and institutional changes that come with that globalization. So naturally, if regional integration is part of a way to enlarge your market, you would say, oh, that would be a good thing. I do think that the challenge here is that because this region is very uneven, you have a large economy like China, that itself is also doing its own policies, some very active on industrial policies, that's creating a little bit of structural challenges for the rest of East Asia. So the way in which we can generate per capita income convergence may be changing. I'll give you an example. I mean, we all know China is a leader of a lot of technology products. They're doing a lot, clean tech, etc. But what we find in the data is that, so since 2010, China has been losing global market share on labor-intensive manufacturing, but then it's sort of stalled out. In the last 4 or 5 years, it's just been plateauing. In a way, the question is, to what extent is weak demand and kind of, scale efficiencies and industrial policies curtailing kind of the, causing a kind of a slowdown in the migration of that, and that's impeding some of the manufacturing development model. How can small companies in small economies around the periphery manage the impact of that? So I think that's where people do raise a question about, well, is integration, I mean, certainly there's a lot of positive things with integration, but there's also these imbalances and distortions, which is why we need to talk a little bit more about rebalancing. And if the real goal is to increase market access, we really need to think bigger beyond the region, right? That's why, this rebalancing agenda is not just important for the rest of small countries in managing its trade relationship with China, but hopefully it will also manage China's trade relationship with the rest of the world, which will enlarge our pie. Maybe for US it's very difficult because, US-MCA negotiation, there's a political element to that. But if you remove that, you want to enlarge the pie as large as possible. And that's, I think, where I can see why people do raise the questions about integration just for integration itself, when we haven't figured out some of the negative spillovers of large industrial policies of very large centric countries in this region, I think.
Right, thank you. I think, my personal view is that, of course, there may be at some point we can talk about whether there's too much integration, but from a trade theory point of view, right, when we think about Krugman's contribution to trade theory, traditionally, we think about comparative advantages, but Krugman's contribution really says that you need economies of scale to reduce the cost of production and the unit cost. And that is one very important reason that we need to reach a certain scale to benefit from the economies of scale. The other, of course, is that differential products, right? Not everybody is good at producing everything, so we specialize in some products and then we trade with each other. So that also calls for more integration in the region. So personally, I think we are not there yet. I think there's much more room to be further integrated. At some point, maybe we could be reaching the point that you want to tilt the balance a little bit towards more resilience. But let me hear from Deputy Governor Sham.
Yes, Dong, I do agree that when we look at in terms of ASEAN, is that what I mentioned earlier, in terms of intra-regional trade is only at 22%. And when you look at Europe, EU is almost 50%. So there is still a scope. I do believe there is a scope for us to be more integrated. But when we look at about integration, it's not about integration for the sake of integration. It is, in fact, it's part of the diversification strategy. So through diversification, in this case, in terms of the economic, in terms of markets, then we would obviously enhance our resilience. Some data, when we look at it, the trade, ASEAN trade, that 20% of our trade is with China to meet the final demand in China. Almost 19% is to the US. So within that context, I think that is that opportunity for us to actually get more trade within ASEAN. And as I mentioned, ASEAN is a huge market. And so the question is, how can we leverage on this? And one aspect is obviously is when we have the higher income, then the domestic demand will be a source of growth. And through this, there will be a greater regional trade. And when we broaden it to ASEAN+3, this is where the thing that I mentioned about the savings and how the mobilization of financial resources from within the ASEAN+3 would help clearly meet the financing needs and help to boost investment in ASEAN. So that is an important aspect as well, which would further strengthen the integration within ASEAN+3. The second source of integration within ASEAN+3 is in the form of foreign direct investment. And here we're talking about the more technologically advanced production that will come from the +3 into ASEAN, which would help ASEAN to move up the higher value chain and improve our economic complexity. All of this would certainly make ASEAN more stronger in terms of our private investment, our consumption, and reinforce trade within the region. Thanks.
Thank you, DG Sham. Chantavan, any thoughts?
I would echo that argument as well, that yes, there may be vulnerability for certain sectors, but you would find that those industries that are most exposed to trade will be the most competitive, that will fare well over the long run. Of course, in the short run, that's why we all have sort of like a structural adjustment loans or trade mitigation funds to help those sectors, but I don't think we should lose sight of the fact that integration is the only way for small open economies that are trade dependent like ours. Of course, if you can't compete with your peers, your neighbors, how would you then compete in the global marketplace? So I think it's a matter of timing, and like all trade-offs in any country, it's already difficult to trade off among sectors within our own economy, to trade off among our negotiating partners within the region, but at least they are your peers before you go into the bigger market. So I would persevere in the integration efforts and do whatever we can do, pace by pace, sector by sector, at least to warm up the industries that would benefit and would showcase that to other sectors that continue to be shielded from competition. Thank you.
Thank you. I would actually like to open the floor. If you have a comment or a question you want to raise, please do do raise your hand if I can see you. While you prepare to do that, there are still a couple of questions sent around, and the one is specifically addressed to DG Sham. But I will read it out, and I'll give you a couple of minutes to think about it while I address another question. DG Sham, would the greater integration of regional fast payment systems, such as Project Nexus, or development of crypto assets for payments like stablecoins and the CBDCs are not part of crypto assets, by the way, be better for ASEAN+3 economies? Which of these options would the BNM prefer to see become a preferred payment method in Malaysia? So that's the question from Jono Thompson of Central Banking Publications. I will give you a couple of minutes to think about that. At the same time, there's another question about payment standards. With the bifurcation of US and China tech standards, particularly in areas like digital payments, data, and AI, is a unified ASEAN position realistic? Does the region risk fragmenting into camps aligned with either US or Chinese technological financial ecosystems? I don't know whether anybody from the panel would want to share any thoughts. I have some thoughts, but I will share after one of you probably is willing to share.
I can share some observation actually. In the morning's presentation by Professor Green, he talked about the dollar, right, and the renminbi. And we do see already some the two blocks. If you look, for example, if you look at the CNY internationalized use, if you combine the SWIFT and CIPS based on Professor Green, it's relatively flat. Right? But if you look at who is using in the CIPS block, the RMB block is mainly, I'll say, the China block. Very similar this year, people all talk about the dollar, the gold. The gold share in the central bank reserve has been increasing quite significantly. And again, there's a very interesting research comparing the dollar block versus the renminbi block. And it's interesting that the gold share increase mainly happened in the renminbi block rather than the US block. So yeah, and of course, technology side, AI, yeah, unfortunately, we see actually the two block actually is competing, right, at this moment.
So on this one, let me just share very briefly one thought I have, is that infrastructures are very hard to build. But once they are built up, they are quite resilient. So think about the SWIFT. SWIFT is still a very important part of the global infrastructure. It has been very resilient. It has everybody in it. It does a huge amount of business with Chinese banks. And I don't think we should think about global financial market infrastructure in block terms. And it's possible, we already have international standards, for example, ISO 222. These are very important standards that it doesn't matter who is taking the initiative in setting up such projects. As long as we adhere to these standards, I think global financial market infrastructure will very likely remain united rather than fragmented. That's one thought I have. But maybe let me come back to DG Sham on the question about Malaysia's, which preferred method you would have.
Thank you, Dong. As I mentioned, is that a lot of efforts for us and our counterparts in the region, a lot of efforts have been put in establishing these cross-border payment interlinkages, and we have seen this has borne fruits. 26 live cross-border connectivity, and now it's Project Nexus. Again, as I mentioned, we're very, very excited about Project Nexus, which again get support from regional central banks as well. And then when it comes to asset tokenization, Bank Negara has, for example, established what we call the Digital Asset Innovation Hub, space for the private sector to work together with the central bank to look at the potential use case in terms of, as well as for them to establish the proof of concept, for example. And recently we issue a the discussion paper on asset tokenization. Our approach is that there must be real-world economic benefits to asset tokenization. And there must also be appropriate identification and ways to mitigate the potential risks that could be used. So we are exploring this. We are working, providing a space for the private sector to come and test the idea and the potential solutions with them. So we remain open on that space. Thank you.
Thank you, DG Sham. Again, if there is any comment or question from the floor, yes, Louis, please. Mic is coming.
Thank you. Thank you, Horan. I wanted to get back to some of the points that Johanna made and about the trade relations between China and ASEAN, because the regional integration is a theme of the event. A lot, I think one of the earlier speakers explained how a lot of the ASEAN+3 integration on trade that we've seen in the last few decades has been between China and the ASEAN countries rather than between the ASEAN countries themselves. On top of that, a lot of the increase in trade between China and ASEAN countries in the last 10 years has been increased Chinese exports to the ASEAN countries. The exports of ASEAN countries to China has not done all that well. Some commodity exports on the manufacturing side, it's a bit challenging. So my question to the panel is, given this actually quite serious challenge that the manufacturing sectors in the ASEAN countries face in terms of competition with the Chinese manufacturing sector, what can the ASEAN governments and perhaps also China's government do to keep this manageable and to keep integration as a theme rather than more dark scenarios like trade protectionism? Because the forces are actually quite powerful.
Very good question, Louis. Thank you. Any thoughts from the panel? Johanna?
Well, like I said, I think this discussion about rebalancing in China always comes up. I do see some signs of kind of hope and positive progress. Like China itself is talking a lot about high quality development, opening up high quality services. They're focusing a lot on AI and so I'm hoping that as they move towards higher value, they start, maybe it was just very tough in the last couple of years because of the property down cycle and the deflationary pressures. I mean, again, maybe some of that could gradually adjust, but I agree, I am worried that without more proactive policy support, it could be kind of challenging. The one thing I'm hoping will be encouraging is China seems to be more supportive of facilitating overseas direct investment, outward direct investment by Chinese companies itself, and a lot of them go to ASEAN. And just like the flying geese model, like we're hoping alongside ODI will come technology transfers and kind of to allow this natural migration of development. And I was kind of encouraged. There was a statement from the Chinese Commerce Minister recently talking about the focus on GNI rather than GDP. And I do notice that when you look at China's kind of primary income balance in the current account, it's running at a deficit of about 2.4% of GDP, and in Japan is 6.6% surplus. So you kind of think, if you're talking about rebalancing, maybe there should be a broader thinking about how to boost income, including income from abroad. So there are some signs, but I have to say the challenge, though, with a more aggressive move is because you still have lack of jobs, you still have a soft labor market in China. So sometimes my worry is, holding on to this labor intensive, maybe partly because of this, need to preserve jobs, that it becomes a very sensitive issue. And I think it is, and I think for most small countries, I agree. I mean, they're price takers. There's nothing much you can do. You just have to kind of accept it. But I'm hoping that it would be more of a win-win if there is this migration and natural shift in the development model that will allow manufacturing-led development to kind of be more promising for some of the lower-income countries in this region.
Dong, if I could add, I do agree with what Johanna mentioned. When we look at the China Plus One strategy, at least from Malaysia's experiences, we have seen that not only the non-Chinese companies that are diversifying, establishing presence in ASEAN, in Malaysia, increasingly we are also seeing that even the Chinese companies are establishing presence through foreign direct investment in the region, and in Malaysia has certainly benefited from this. And then second is that these investments that's coming from the Chinese companies from China are also slowly moving up the more high value production and higher technology. So certainly this is positive for the region, for Malaysia. And secondly is that, of course, as we, the region, including China, focus our attention in getting our domestic demand, in particular private consumption, growing at a faster rate, that would also help intra-regional trade. Thank you.
Thank you. Chantavan, any thoughts?
Going back to the flying geese model, back in those days when the Japanese were investing in our economies, you would see the parts and components, the SME that are being developed around the bigger investment-led growth from the major economies. So I think it's an episode we've all gone through. I mean, as small open economies, you cannot modernize or industrialize on your own. The catching up is far too long. And without the catalyst from big economies, it's probably the only way to bring that flying geese model up. And we've all learned from the ability of our own human resource to absorb that capacity when the foreign investment comes. And of course, to be able to enjoy the higher income that comes with industrialization would be a self-sustaining model. Of course, along the way, there are dislocations. I know, I understand from Louis' questions, but I think looking at the past experience from Japan, I think we will be led by that as well. Thank you.
Thailand actually had a lot of experience in the last round of accepting Japanese foreign direct investment. Some of these experiences are being, I think it's still in the initial stage, but being already, you see some signs are picking up. Of course, there is this major project called the Johor, Singapore, Malaysia industrial park in the Johor region. And we're hoping that would provide an example for many ASEAN countries to come together for this new round of advanced manufacturing. That's an important opportunity for us to watch. So, yes, Bob. Hi.
So in the European context, the deal with the U.S. includes some commitments for investment and trade in energy. There are questions about what instruments might be in the hands of the folks in Brussels to actually deliver on those commitments, but let's put that aside. Nevertheless, the U.S. is dealing with the EU as a group in this discussion, whereas it's been a series of bilateral deals or deals in the making in this region. And when you speak to officials in the different countries, they're talking about it in very different terms. It seems like the questions, the problems, the term sheets are quite different across the bilateral relations. I wonder how that plays out.
Any thoughts on the panel of bilateral negotiations versus collective negotiation? Johanna?
I mean, in the end, that's how Trump likes to do it, right? So bilateral. But I think the good thing is, at least for most of ASEAN, even though it's all bilateral, I mean, the tariffs are all, with the exception of a few, but generally the tariffs are kind of all in the similar range around. Of course, Singapore is an exception, and then we have Myanmar and others, but roughly around the 20% range. But look, the problem is you just never know with Trump, right? I mean, we're in a different regime. If something happens next year and he wants to extract something, there's nothing much, then there's always the risk of like, there will be some side deals that can happen. But look, I think by far at this juncture, China obviously has a lot more leverage. So they're not, the ability of US to do extractive policy making with China is very much curtailed. And so that gives China hopefully a little bit more degrees of freedom to kind of choose its policy space for its own domestic objectives. And I think integration with ASEAN and kind of boosting the growth and prosperity in the region, I think is in China's interest. So I'm hoping that that still provides a bit of space for this region, regardless of these bilateral nature of US policy.
Any comments, Habing, or anybody else on the panel?
Yeah, I think that just one thing to add on Johanna's point, actually, when you talk about the U.S., so I mentioned the Supreme Court hearing, public hearing on the IEEPA tariff. So two possible outcomes, right? That if the IEEPA is revoked, people talking about, say, replacing with the new, like Section 122, but there could be difference. IEEPA allowed a lot of discretion from President Trump to impose country-specific tariff. But under Section 122, my understanding is that up to 15% for maximum 150 days, but it has to be uniform. So in that case, actually, one tricky point is that if the IEEPA tariff is truly revoked and replaced by the Section 122, probably that will mitigate the President Trump's power to randomly say that they impose a country-specific tariff.
All right. Okay, so we have only a few minutes left. I don't see any other hand. So let me ask each panel to maybe just conclude with 1 minute of your thoughts and to share with the audience, and then we will. I think I think the audience will take away from what you have to say today. Can I ask maybe? In reverse order, Johanna, to start first.
Yeah, so I mean, we talk a lot about resilience, right? But I think we should not be complacent and be happy with, I mean, resilience is great. But we also have to recognize that there are some economies in this region that need higher growth. Like resilience is a necessary but not sufficient to achieve growth. And I still worry a lot about the distributional implication, which is why we need to have a more active discussion. It's just not about integration, but it's also an active discussion about rebalancing and rebalancing of policies. And rebalancing comes in many ways. I mentioned a little bit about, for example, the China rebalancing and the rebalancing of the manufacturing, stages of manufacturing development model. Some have to move up, some have to migrate down. There should also be an active discussion about, again, intra-Asia, ASEAN demand. Why has it still been weak? Should we talk about rebalancing of not only FDI production supply chain, but our portfolio flows, if we're moving to multipolarity, is our portfolio allocation reflecting that new reality? And to some extent that we have more regional integration, it does. One of the phenomenal things I've seen in Asia is to the extent that we have these periodic shocks like Liberation Day, and yet our local bond markets, the beta of local bond markets to kind of US rates or DM rates have broken down. So there is some level of resilience in terms of our beta and in terms of our term premium. And it does raise questions. This is a net exporting creditor region. We have built up a lot of external financial assets. The question is, if some of that financial assets get recycled back in this region and it creates more resilience, it also raises the question whether we need to rethink what is the policy buffer that you really need? Maybe we have more fiscal capacity than we think. Because if we're always talking about buffer, we cannot grow. We cannot create the distributional impact that we need to preserve the quality of policy making. I think that's kind of this whole rebalancing debate. And the last thing, and again, it's very, very political, but because I do worry a lot about AI, about jobs, income distribution, and not all of it can be addressed by fiscal policy. So I always think, migration is kind of a income redistributive policy as well. You've got a lot of aging population in the north, you've got a lot of populace in the south. So I always feel that maybe that's another way to help kind of generate and boost potential growth in this region.
Thank you, Johanna. Can I ask Chantavan to share maybe
I think
concluding thoughts?
Yes, about 3 areas we talk about: fiscal, monetary. The structural part is the most difficult, and that's why I come back to the liberalization, the trade facilitation, bringing down non-tariff barriers, and many other barriers. Those are very micro foundational. It's at firm level, and it requires a constant dialogue between the authorities and your own industrial champions that you would like them to go cross-border and make that investments. So I would encourage that kind of dialogue to go on and as much as possible. And that's how I think we, the finance, fiscal, and central banks can be supportive of the real sector. Thank you.
Thank you. Haibin?
Yeah, so I think we all agree that the regional integration is a major source of the resilience for the region, and also there's a room for further enhancement for this interconnectivity. But to make this integration path sustainable, I like to call back actually what Professor Tan said from the very beginning, 3 conditions for globalization. So I think we can draw some lesson also talking about the regional integration. So first is the technology. Second is the leading economy has to be benefiting from this the integration process. I would like to add on that actually it should be a win-win situation, not only in the leading economy, but also everyone, every participating country need to benefit from this integration process. But the third point is also very important, actually domestic policy, particularly those policies to address inequality. Is important because you need to also make sure not only across country but within country everyone or the majority will benefit from the process. Otherwise, you will see all this political tension actually will backfire actually to put a pause button on this integration process.
Thank you, Haibin. DG Sham?
Yes, I started by saying about the 2 forces that would have implications, wide-ranging implications for the region: geoeconomic fragmentation and AI revolutions. And the policy response to that and this new environment, first is that for central banks, many of us in the region, and certainly for Bank Negara, the priority is always to preserve stability, enhance resilience. Second, I think domestically, structural reforms, Chantavan mentioned this. This is very, very critical. For Malaysia, a lot of efforts have been directed towards attracting high-value investment, looking at the labor market, for example, and as well as fiscal restructuring and fiscal consolidation to some extent. So these reforms are important to ensure that not only that we have sustainable growth, but we also have inclusive growth. That what Haibin and Johanna is talking about, to ensure that the benefit of growth actually are more widespread and benefiting the public in general. Regionally speaking, I believe that we need to double down on our efforts on regional financial integration. And this is where trust, I think, trust among the policymakers, among the central bankers is critical to drive some of the key initiatives that we have. And of course, at the end of the day, a stronger, more integrated region will bring benefit to all of us. Thank you.
Thank you, DJ Sham. So my own final thoughts, if you don't mind, is that I don't think, we do see signs of fragmentation, but it does not mean we are going to end up with blocks of countries in the world. I think, for policymakers, it's important to take practical approaches to ensure resilience. In my own view, that a plurilateralism based on practical considerations in the sense that like-minded countries can work together and to push on specific projects that will continue to lead to some integration in various aspects. I think that will be a very practical approach to proceed, and we will still maintain some resilience going forward. So with that, I want to thank you very much for participating, for listening attentively to the panels, and of course for the panels for your willingness to share your thoughts. I'm sure everybody benefited from this discussion. Thank you very much. Thank you.
Thank you so much, Dr. He, and to all our panelists for this enlightening and fruitful discussion. And now, may I invite everyone to stay on the center stage for our group photo, please. Let's stand closer together and look at our official camera in the front. Once again, thank you to our panel for providing us a lot of insight and updates regarding the ASEAN regional integration and how can we create an impact from different perspectives. Thank you so much. And ladies and gentlemen, let's give them a round of applause. Thank you, and please be seated. Ladies and gentlemen, this is the end of session 1 panel discussion, and we will now take a break for lunch. We look forward to seeing you back at 12:55 p.m. Hong Kong Standard Time. Thank you. Welcome back, ladies and gentlemen. This morning, we explored the region's macro-financial challenges and opportunities. And in this afternoon, we will turn our attention to the changing global financial landscapes, implications for monetary and financial stabilities. We'll begin with keynote speeches from two distinguished speakers, followed by a panel discussion later. Just wanted to highlight, as one of the keynote speakers is joining us virtually, and we will have a special Q&A section with him. So for our virtual viewer, do remember to submit your question online. And for our on-site audience, please scan the QR code at the back of your ID badges. Thank you. In this session, our first keynote speaker is Ms. Julia Leung, Chief Executive Officer, Securities and Futures Commission. With over 25 years of public service, Ms. Leung has been instrumental in advancing financial regulations, market development, and international cooperation. Her leadership continued to shape Hong Kong's financial sector. And now, let's welcome Ms. Leung.
Distinguished guests, ladies and gentlemen, good afternoon. It's my great pleasure to be addressing this prestigious audience at the 4th AMRO Forum. In fact, it is my first time attendance at the AMRO Forum, and I owe my invitation to Hedong. Otherwise, I normally would not be here, and the reason why I'm particularly excited, I just met quite a number of old friends from my former life at the HKMA, and Chatavan, and Diwa, and of course, Hedong and Kelvin. So I am really glad that I have this opportunity to speak to all of you. The financial landscape we navigate today has changed drastically since the global financial crisis some 17 years ago. Structural shifts have accelerated over the past decade, particularly in the last 5 years. These pivots are catalyzed by a confluence of mega events, forces, from technological innovation and regulatory evolution to macroeconomic upheaval and geopolitical realignment. The more interconnected markets and complex dynamics are reshaping the way capital flows, risks are managed, and resilience is built. The line between public and private markets has become blurred. So will the line between fiat currencies and stablecoins going forward. Navigating this uncharted landscape demands agility and foresight from regulators, deeper collaboration, and forward-looking strategies. These are the qualities that AMRO embodies, and they are also essential for us to regulate for progress in a world of pivots and perils. Now let me focus on some of these transformative forces in financial markets. The first is the rapid growth of the private credit market. Since the global financial crisis, the progressive phasing in of Basel III has increased capital and liquidity requirements for banks. This constrains the banking sector from extending excessive leverage to the real sector to shield the financial system from another shock. This has resulted in the rise of private credit, which comes in to fill the funding gap left by banks constrained by prudential regulation. Private credit increasingly acts as the mainstream alternative to bank lending to support growth and innovation. As a result, assets under management of global private capital have roughly tripled to $14 trillion over the last decade. As leverage provision shifts from banks to non-banks, the risk also spreads across asset owners and non-bank intermediaries. The two sectors are increasingly interwoven as banks provide margin funding to private fund managers and the underlying assets. For a sector of such fast growth, we have seen bifurcation in its asset quality. Recent collapses of First Brands and Tricolor in the US have sounded the alarm bell about the risks of private credit. They can be complex, illiquid, opaque, difficult to value, and susceptible to fraud. Retail participation in private credit is rising too, adding urgency for regulators to closely examine the private credit ecosystem and its key interlinkages with banks, insurers, and other key market participants, investors and counterparties also need greater clarity and transparency on valuations, leverage, and governance structure in order to manage their exposure. To rise to the challenge, we have stepped up our surveillance of the OTC derivatives market in Hong Kong. Under the new requirements effective in September, it is now mandatory to report delta positions of OTC trades to our trade repository, among other data requests. In international forums, regulators are discussing how to standardize disclosure requirements to better manage counterparty risks. Any required disclosure should be proportionate, taking into account the heterogeneity of non-bank financial institutions and concerns about disclosing proprietary and commercially sensitive information. In this light, the industry is well placed to identify the key risks and information needed, and public-private partnership would be helpful to work out the details of necessary disclosure. The second driver of financial market transformation is technological advances in the past decade. Algo trading and machine learning have increased trading efficiency through lower transaction costs and faster execution. AI models enable robo-advisors to deliver automated, tailored investment advice to clients. Asset managers can leverage these models to identify investment signals from a survey of data today. Firms can also improve fraud detection and risk management. Further to this, Gen AI large language model hold even greater promises to boost productivity, save costs, and fuel innovation across the economy. So far, financial firms are using Gen AI mainly to improve operational efficiency, while use cases in trade execution are still nascent. They are also exploring agentic AI to further streamline workflows and minimize human intervention. Moreover, quantum computing is set to empower firms to perform complex real-time calculations. However, as we all know, technology is a two-edged sword. With a surge of computing power, financial stability can be unsettled by new operational risks, data breaches, and cybersecurity issues. AI models can generate inaccurate or biased output, leading to flawed trading signals, unsuitable investment advice, or mispriced risks. These models and their output can be more difficult to audit, validate, and explain. Furthermore, Gen AI models are known to hallucinate. Concentration of AI providers raises concerns on firms' operational resilience and potential correlated market behavior. On top of these, quantum computers may render current encryption technologies obsolete, therefore giving rise to data protection issues. In light of these challenges, we have emphasized to licensed firms that they must have a robust governance and risk management framework and fully understand the AI models they deploy. In particular, for high-risk Gen AI use cases, require firms to have a human in the loop. In addition, to adapt our regimes to changing times, regulators in Hong Kong are developing relevant cybersecurity framework and quantum-safe infrastructure. Now, digitalization and data standardization have improved the post-trade efficiency and driven trade settlement to migrate from T+2 to T+1 in traditional finance. The emergence of distributed ledger technology and digital assets, along with it, is the third driver of market transformation. They are putting instant clearing and settlement within our reach. As we all know, our younger generation lives their lives on mobile phones. The investment behaviors of these digital citizens is very different from the previous generations, which may also explain why digital assets are fast adopted. They are risk-tolerant, prioritize speed, accessibility, and peer-driven information on social media. They also embrace Web3 and 24 trading. This trend is particularly dominant in ASEAN countries, where the median age is about 30. Therefore, Hong Kong is leading the regulatory efforts undertaken globally to build a secure and trusted platform for digital assets. To future-proof our financial markets, a comprehensive regulatory framework for digital assets is in the making. We have in place the regimes for centralized exchanges, advisors, asset managers, and products. After public consultation, we are now finalizing the regulatory regimes for digital asset dealers and custodians. These will be the last pieces of our regulatory puzzle to support a robust digital asset ecosystem. In the meantime, we are seeing increased adoption of tokenized financial products in Hong Kong, such as tokenized green bonds and the SFC authorized money market funds and retail gold products. With varying degrees of tokenization, these tokenized products in Hong Kong had a market size of around US $3 billion. At this stage, most of the tokenization pilots remain nascent, with considerable room for upgrades. Some have achieved modest efficiency gains and cost savings in clearing and settlement, while many continue to rely on the fiat currency to settle the cash leak. Many in the market now hold the long-term vision to put on-chain the entire life cycle of traditional financial products and achieve instantaneous settlement and its finality. The processes should cover subscription, redemption, trading, settlement, and record keeping. Under the guidance of the SFC and the HKMA, firms are now conducting live transactions during the pilot phases of Project Ensemble, where investors transfer tokenized deposits across banks to subscribe for tokenized products. To achieve scale, interoperability is essential. That would require a common blockchain layer to be built for interbank payment and its gradual integration with the broader financial market. In the Web3 ecosystem, stablecoins are used by crypto natives as a currency for exchange. If left unregulated, their widespread use would introduce new risk, particularly in case of large-scale redemptions. With Hong Kong stablecoin legislation coming into effect this August, the HKMA has put guardrails in place to ensure reserve assets backing the authorized stablecoins are properly managed and regularly audited by an independent auditor. None of us has the crystal ball to predict the scale and speed of tokenization or the use of stablecoins for cross-border supply chain payments. However, as Hong Kong continues the digital asset journey, we will be steadfast in upholding investor protection, resilient financial infrastructure, and sound regulation mirroring that in traditional finance. The last driving force is geoeconomics and new pivots in financial linkages. Geoeconomic strategies and tariff resurgence are reshaping global supply chains, fragmenting what was once a seamless global network into regional clusters. In Asia-Pacific, we have witnessed a decisive pivot towards regionalization. Intra-regional trades now accounts for nearly 60% of the region's total exports. Firms are fast adapting their strategies and diversifying production hubs to ASEAN economies. Capitalizing on these opportunities, ASEAN has transformed into a vibrant economic bloc. This realignment is mirrored in investment flows. Despite global headwinds, developing Asia attracted more than $600 billion in foreign direct investment in 2024, representing 40% of global inflows. ASEAN alone drew a lion's share. For Hong Kong to remain a critical financial conduit, financial firms here have forged new ties to the reconfigured regional treasuries, supply chain financing, and capital markets. The Middle East and other regional markets are also looking to Hong Kong for diversification and new financial linkages. This can be seen in the Hong Kong listing of an ETF for Saudi stocks and its subsequent cross-listings on mainland exchanges. And since the trade tension escalated in early April, the SFC has signed 6 MOUs with counterparts in Canada, Europe, and the Middle East, equivalent to the number of MOUs signed in the last 5 years combined. Within Asia, fragmented liquidity and diverging regulatory approaches pose challenges to a more integrated capital market. This will require regulatory collaboration among us in this region, and AMRO is best positioned to deepen our dialogue to build a more resilient and synergistic Asian market. So, ladies and gentlemen, the 4 drivers I mentioned are reshaping financial markets in magnitude unforeseen. Technology, shifting capital flows, and new risk dynamics are redefining the contours of our financial ecosystem. To avoid perils in navigating this transformation, we must pivot to action and collaboration. The imperative for regulators to adapt has never been greater. At the SFC, we strive to be the change that we wish to see in financial markets. We are reviewing our regulatory regimes to move with the times, balancing innovation with stability and growth with prudence. Rules must evolve to safeguard resilience while pushing for progress. We encourage market participants to embrace collaboration, transparency, and future readiness. We must also continue to leverage on regional institutions like AMRO in fostering dialogue and harmonizing differences across jurisdictions. When I mentioned Chadavan and Diwa, these are the friends that we made when we were pooling official reserves back in the 2000s, you remember, to form the ABFs and the PIF. And Bob, you were there actually, at the BIS. So at that time, it was in response to the Asian global crisis. We believe in recycling savings into investments. Now, 30 years on, we actually have moved, all of our capital markets have actually grown substantially. So I think this is time, given all these headwinds that we are facing, that we should have worked towards a more integrated capital market. So together we can turn this disruption into opportunity, division into trust, and global challenges into Asian prosperity. So thank you very much.
Thank you very much, Ms. Leung, for your valuable insights on how digital innovation is reshaping the financial services. And next, our next speaker will be joining us virtually is Mr. Hong Shong-shin, Economic Advisor and Head of the Monetary and Economic Department, Bank for International Settlements. Mr. Shin played a key role in shaping the BIS research and policy work on digital innovation and financial stability. And right after his presentation, we will have a Q&A session with him. For Zoom viewer, please input the questions into the Zoom chat. For YouTube viewer, please click the link in the description box. And for Chinese-based viewer, please input your question in the NovaWeb Q&A box. And for our on-site participant, you can scan the QR code at the back of your ID badges. Without further ado, let's hear from Mr. Shin.
Hello, good afternoon. It's a great honor to join you. I wish I could have been there in person. And it's great to share the session with Julia. I'm going to have a slightly different orientation in my presentation. I'm going to be focusing on the shifts in the financial sector, and in particular, the FX market. Next slide, please. If we look at this in the broader historical context, before the GFC, we had lending to the private sector growth much faster than lending to the government. But after the GFC, and you see it in the next slide, The lending to the private sector was subdued, but lending to the government was increasing at a much faster rate. And in the next slide, you see that the impact of COVID was to accentuate that process even more. So it's very much the lending to the government, in particular the size of the sovereign bond market, which is a very, very important theme. Next slide. Now, of course, the bond market is a global market. And here we have indicated the major regions in terms of this hexagon. And next slide shows the increase in the cross-border flows, the cross-border holdings of fixed income securities between 2015 and 2023. The blue ribbons indicate increases, while the gray ribbons indicate the decreases. And you see that the biggest changes have been between the US and Europe. In particular, the European holdings of US fixed income securities has been the really big theme in this period. Next slide. And the one after that. Next slide. Now, the reason for focusing on the change between 2015 and 2023 is to get at the total. Now, most of that increase has been in the form of the holdings of the private sector. If we look at the official holdings, and here I'm focusing here on the foreign holdings of US Treasuries. The official holdings peaked at around 2012 and has since been pretty flat. Whereas if you look at the next slide, in blue, you see the private sector holdings, and the increase since around 2012 has been very much attributed to the private sector holdings. The blue line there indicates the proportion of the total holdings held by the private sector. So the story here is, if you focus on the period 2015 to 2023, we are simultaneously looking at the total increase, because the pink has been fairly stable, but also the primarily private sector-led increase in the holdings of fixed income securities. Now, because these cross-border holdings involve foreign investors, mainly foreign private sector investors, there is an important element of there is an important foreign exchange element to the holdings. Next slide. And the one after that. Let's go to the next slide. And therefore, there has to be a way that the investors can mitigate the risk from currency fluctuations. And the best known way of doing that is through the use of FX swaps. An FX swap is a transaction where at the beginning you exchange principal amounts at the current exchange rate. Next slide. With the promise to unwind that transaction at the conclusion, at the maturity of the swap, at the pre-agreed forward rate and at a pre-agreed date. So if you look at the next slide, we see the prevalence of these swaps in our BIS over-the-counter derivatives statistics. In particular, the outstanding amount of FX swaps has grown very rapidly over the last couple of decades. And next slide. The most important segment of this has been between dealer banks, from which we get the data, and the so-called other financial institutions. So these are the non-dealer bank financial institutions. They include long-term investors like insurance companies, pension funds, and other investment funds, but also the non-dealer banks as well, who will then be acting on behalf of their clients. In the case of FX swaps using the other financial institutions, we've seen a threefold increase between 2009 and the latest number. So one number that you can keep in mind is roughly $60 trillion worth of outstanding amounts of FX swaps are due to the activities of other financial institutions. Next slide. Let's see how a euro area long-term investor, let's say a euro area pension fund, uses an FX swap to hedge the currency risk of a US dollar security. So let's start with this example. At the start, this euro area pension fund simply holds euros in cash, euro-denominated securities, and the liabilities are the obligations to its beneficiaries, mostly in euros. Next slide. What the euro area pension fund can do is then to engage in an FX swap. So it acquires the green segment, which is US dollar cash. So this is a deposit in a large dealer bank. And then it also acquires these off-balance sheet, these forward obligations and forward claims. So you owe dollars in the forward transaction, but then you also have a claim on euros as well. But with the dollar deposit, next slide, you can then buy the US dollar security. And so in this right, the diagram on the right, the pension fund is holding US dollar securities, but then the exchange rate is hedged because there is an equivalent forward obligation of dollars. So you have a claim in dollars as well as an obligation. And so the dollar exchange rate then can be hedged. Next slide. And the one after that. Now, I think one thing that we have noticed in the run-up to earlier this year was the hedge ratios of institutional investors had become fairly low. And what that means is only a part of the dollar exposures are hedged, but in particular, some institutions will have lowered the hedge ratios even further. And indeed, some institutions may not be hedging at all, and they'll be holding the dollar assets without a hedge. So this is a picture of a euro area pension fund that is holding a US dollar security, but without a hedge. But if turbulence breaks out, like it did in April, the pension fund can nevertheless mitigate any losses from dollar depreciation by engaging in a hedge after the event, ex post. So next slide shows you what happens when you then engage in an FX swap directly after the exchange rate starts to depreciate. What happens here is that you have now engaged in an FX swap. And so you see the dollar deposit in the middle, as well as the forward claims and obligations. But with those dollars, whereas before you would buy a US dollar security, now you would simply sell that dollars in the spot market. So next slide. And so the green dollar deposit in the middle has now become a euro deposit. So you have sold dollars in the spot market and you have bought euros. And so the right-hand diagram is exactly a similar one as to the previous one, except that the previous example, where you're hedging before buying the security, but you have now hedged ex post. Of course, what's happened here is that you have sold dollars into the spot market, and therefore you have put downward pressure on the value of the dollar. And as you do that, you can easily get into a feedback loop where the more you sell, the more the dollar depreciates, which then increases the incentive to hedge even more. Now, let me give you a little bit more evidence, and the next slide shows you that. From our triennial survey, we're currently digging into the data. So the triennial survey is the survey conducted by the BIS every 3 years. We survey around 1,100 dealer banks in 52 jurisdictions. So we have a pretty comprehensive view of over-the-counter derivatives activity around the world. And the headline number this time is actually quite notable. So for this year's survey, the daily turnover is $9.5 trillion. So that's a very, very large number. It's also a very large increase relative to the last time we did this in 2022. Now, it just so happens that the survey period this year was April, during the height of the turbulence. That was not by design. The sample period was, of course, determined well in advance, but it just so happened that the sample period coincided with a period of very intense market activity. And so the very large increase that we see a 28% increase in the total amounts. We believe is largely attributable, or to some extent attributable, to the turbulence in the market. The other piece of evidence that's also very interesting is that the activity in the spot market and in the outright forward market were the biggest increases. It's the FX swap segment, which is by far the largest, but we see the largest increases in the spot and in the forward. Now, this makes a lot of sense to us because when you're hedging ex post, another way to do it would be to ask the dealer bank for a forward position with a short dollar leg, embedded. And that would mean that the dealer bank would then have to hedge. And the dealer bank would hedge by selling the equivalent amount of dollars in the spot market. And so whether you hedge through swaps or whether you hedge through a forward transaction, there would always be an equivalent spot transaction. So there's this potential for a feedback loop, which to some extent we believe was responsible for the events in April. And the other aspect to bear in mind here is the longer term and financial stability aspects. And let me finish with that. Next slide. This is the same chart for the total outstanding amount of FX swaps, but indicated by the maturity of the swap contract. And the large yellow segment here indicates the swap contracts that are less than 1 year in maturity. Of course, in practice, we know that the short-term segment consists of contracts that are of much shorter maturity than 1 year. So they're typically 1 month or 2 months. And there are even shorter maturities than that. What this segment also indicates is the maturity mismatch, potential maturity mismatch on the balance sheets of the long-term investor, because the way you hedge is you borrow dollars and you buy securities with those borrowed dollars. That's the way that the swap market works. But the borrowing is with a dealer bank, and the dealer bank will lend you dollars on a short-term basis. So you see that the yellow segment is by far the majority. That means that you're borrowing short-term but lending long-term. And even if the investor itself is a long-term investor, you are taking on a maturity mismatch. So there is a trade-off here between how much currency risk you bear and how much maturity mismatch risk that you bear. And the more you hedge, the more maturity mismatch risk you're bearing. And the risk here, of course, is that if you find yourself in a period of a dollar shortage, you will need to join in the scramble for dollars together with the other short-term users of dollars. And we saw that during the Great Financial Crisis, and we also saw that during the March 2020 episode. And during the April episode, there were just the incipient signs of something happening, but of course that was prevented with the reversal of the tariff announcement on April 9th. But of course, this is something that we should bear in mind as we go forward. So let me go to the final slide. These are the links to the annual economic report chapter, where we lay out the details of the arguments much more fully, as well as API's bulletin that we published, and it was primarily authored in our office in Hong Kong with authors there. And the ex-post hedging argument is developed more fully there. So let me conclude here and hand it over to Dan.
Thank you very much, Mr. Shin, for your stimulating presentation. Please stay online with us. Now, may I invite our moderator for the second panel session, Mr. Danny Rees, Head of Central Bank Cooperation, Monetary and Economic Department, Bank for International Settlements, to lead this Q&A session for us. Please welcome.
Well, thank you very much, Hyun, for that stimulating presentation. I'm lucky enough to work with Hyun, so I get to speak with him every single day. And every time I do, I always learn something. So that was really fantastic. Now, just while I'm waiting for some questions to come in from the floor, Hyun, I thought I might start off with one of my own, which is you highlighted how changes in global financial intermediation, and in particular, the rise of MBFIs have made global and monetary and financial system more interconnected and potentially amplified the transmission of financial shocks across borders. But at the same time, this morning's session, which focused on developments in the real economy, we heard how there's greater fragmentation there. So I guess my question is, how might this fragmentation on the real side affect developments in financial interconnectedness? And can we sustainably have an environment where we have a very connected financial system, but an increasingly fragmented real economy?
That's a great question, Dan. And I think you've really got to the heart of the matter there. And I think the event today really is a very good forum to put these two issues side by side. So clearly, on the fragmentation of the real economy, in particular fragmentation of trade, or rather, as Julia laid out in her presentation, the greater regionalization. So that is really about the flow of real goods, and in particular the operation of global value chains. But the financial aspect, of course, follows along currency lines. And so as long as the working capital and as long as the invoicing is done in US dollars, we will continue to see these financial flows, very much still interconnected. And Given the outstanding amounts of US dollar denominated securities that will be held by global investors, these long-term flows are also going to be indicating this, highly connected set of holdings. Let me just mention one thing, Dan, that I didn't have time to go through. Now, in the hexagon chart that you saw with these very, very large flows, the important point there is not the net flows across regions, it's the gross flows. And gross flows means what is the size of the portfolio of holdings in one region vis-a-vis another region. Of course, there's also a compensating flow going the other way. So whereas, of course, there are very large holdings of non-US investors of US fixed income securities, there are also very large holdings of US investors in Euro area and in Asian fixed income securities as well. And what matters are really the size of those gross flows, not simply the net flows. And this is why, for example, the largest holdings are of European investors vis-a-vis the US. That's where we've seen the biggest increases. And this is so even though the current account balances are largest between Asia and and the US. And so when we think about financial flows, we really have to focus on the gross flows in order to see where the risks lie, to see where the hedging needs are, and so on.
Thank you very much for that, and I think that really speaks to the relevance of the two sessions that we have today. Because on the one hand we do have this fragmented real economy, but Hyun, as you mentioned, there's increasing interconnectedness on the financial side, which can go hand in hand with it. We have a question from the floor that I think follows very naturally from that one, so let me go straight there. The question is, do you see any sign of loss of confidence in the US dollar in the recent period? And I think here it's speaking specifically after the events of April. And if so, would that change the messages from your presentation?
Yes, so if you, and thank you for that question, which I think is a very, very important question. The second source that I highlighted at the end of my presentation, the bulletin on the ex-post hedging, addresses that question much more fully. So I recommend that that you could actually take a look at that. The short answer is, if we look at the short answer is no, in the sense that if we look at the portfolio flows of US securities in April, we don't see a very visible outflow from the US. So there was, in fact, a very small outflow of around $50 billion in April. But actually, that's really a drop in the ocean compared to the size of these flows. And what we saw in May was that there was a large reversal of that. So there was a huge inflow into US dollar securities in May, and that continued into June. So if the criterion for the loss of confidence is, was there a concerted portfolio outflow from the US, the answer is no. But having said that, of course, over the longer term, there could be a movement in the strategic asset allocation across regions. And there is certainly anecdotal evidence that many investment boards are having very deep discussions about these global allocations. But as far as the evidence is concerned, there is no evidence so far.
Thank you for that. And this will be an issue that we'll touch upon in more depth in the following panel. So it's a very nice introduction to that. Let me move in a slightly different direction now. So one of your first graphs, Hyun, showed the changes in borrowing by the private and the public sector. And one of the messages there was that a lot of the increase in borrowing, or an increasing share of the increase in borrowing since the GFC, has been through the public sector. And then he touched on later in your presentation, ways in which stresses in government bond markets can be amplified and undermine financial stability well before conventional indicators of public debt sustainability can flag a problem. Now, I think most people in the audience know that various members of the international community have been taking steps to strengthen the resilience of these core financial markets that are affected by this. But maybe I could ask you, is this enough, and what other measures could or should be needed?
Thank you, Dan, for that. So that was the part that I had to go over very quickly because of lack of time. But let me elaborate on your very important points. So one of the slides that I skipped was a slide where I lay out why the conventional measures of fiscal sustainability may be a little bit misleading. So conventionally, we think about fiscal sustainability in terms of the interest rate on the debt versus the growth of the economy. So it's R minus G, so-called. So when R minus G is low or even negative, then the fiscal position is sustainable or it's very healthy. When R minus G is very large, this is when fiscal sustainability concerns, may start to emerge. And there's a net present value calculation, which will decide whether you're sustainable, whether your fiscal situation is sustainable or not. The problem with that type of approach is that, of course, that gives you a sense of the long-term sustainability. But in the short term, financial stability considerations can kick in well before those long-term fiscal sustainability indicators, start to matter. So in particular, when you see a sharp increase in government bond yields, so for example, if you have a rapid steepening of the yield curve, then that can put in question the sustainability, not because of the long-term demographic or structural changes, but because the financial stability challenges will then put fiscal sustainability under severe question, in particular when there are very rapid portfolio outflows. And of course, one issue that is very much at the center of debate these days is the short-term funding market through repos and how repos are being used to finance very high leverage in government bond markets. And the very high leverage there is not an issue because of credit risk as such, because the government bonds are not subject to credit risk, at least not in the same way as for private sector claims. But it's more that when there's a deleveraging episode, you see very large changes in the prices, and in particular a spike higher in the government bond yield itself. So to answer your question, what can we do about these types of risks? Well, to some extent, it has to do with the conduct of the highly leveraged players. So how do we deal with leverage of the non-banks? And there, as Julia also mentioned in her presentation, there are regulations, there are different supervisory guidance that can be employed, and this is certainly very high on the FSB agenda at the moment. But in the end, there has to be, of course, the lender of last resort function of the central bank. In this case, this would be more of a liquidity provision function. And of course, that has many side effects, and it's something that the central bank will need to steer clear from during normal times. But we have seen in the past that the central bank may need to come in as a last resort.
Thank you. Now, I have a question from the floor that I think follows very naturally from this, and it moves to the other side of the picture. So we talked about the borrower side, the government bonds. This is moving to the lender side. And the question is that part of what we've seen in terms of the rise in government borrowing is a shift in intermediation from the banking sector towards the non-banking sector. And arguably one contributor to this has been post-GFC changes in regulation that have affected the kinds of assets that the banking sector can hold. And he talked at the end of your presentation about risks potentially flowing through the banking sector nonetheless. So the question is, were these changes in financial regulation a mistake? And would the financial system be less risky if banks instead of non-banks were more involved in these kinds of financial markets that you're discussing?
That's a very, very important question, Dan. And I think it's very important to point out that the banks are more important than ever and are more interconnected than ever. So let me explain what I mean by that. It's true that the frontline investors, so the investors who directly hold government bonds, tend to be long-term investors like insurance companies, pension funds, sovereign wealth funds, etc. But for the FX swap market, which is ultimately what is enabling all of the global portfolio flows, the FX swap market is primarily a banking sector market. And that is because the FX swap contracts are provided by dealer banks who can make money fungible across currencies. So, you know, when an insurance company engages in an FX swap, it does that with a dealer bank. And these dealer banks are also precisely the same dealer banks that are active in the repo market. So these are the short-term lenders who allow leverage of the relative value hedge funds and so on. So in fact, what I would say is the more you worry about the non-banks, the more you have to worry about the banks, because ultimately it's the banks that enable the leverage of the non-banks. So in that respect, in fact, loosening regulation would not be the answer, because it would simply make the non-bank issue even more acute. I think the way to think about this is the more global the financial markets become, the more FX swaps and repos have to be at the center of the system. And for that reason, the banks are actually bearing even more risk than they were before. So we need to think about the financial system as a connected whole. And this is also why any problems in the bond market and in the repo market has the potential to spill over to the FX swap market, in which case this will be a problem that affects all investors everywhere, not simply in a particular jurisdiction.
Thank you very much. Now we have a couple more questions here that have come in, but in the interest of time, let me just combine them into one, which is a very broad question, Hyun, and goes probably a little bit beyond what you've been talking about today. But I think, given that I get to talk to you every day, but for this audience, this is for once in a not as often opportunity. What keeps you up at night regarding global financial stability?
So that's, of course, there are very few nights when, we can have, long, good night's sleep these days. No, I'm just joking. I guess the issue that I just described, I think would be the key one. So at the moment, the financial system is very much a system where we have shifted from lending to the private sector and the mortgage markets to one where the securities market, and in particular the government bond market, really sits at the center of the financial system. And although credit risk is less of an issue, liquidity risk and these big shifts in exchange rates and so on, the market risk really is at the center. And although we traditionally focus very much on the banks in terms of their credit risk, the other, this interconnected nature of the fixed income markets with the FX market and with the short-term money market, I think is going to be a really crucial theme, going forward. And although we didn't have a chance to talk about it in this session, but I see that you have other sessions today, the emergence of stable coins and the development of the monetary system is going to be a crucial theme. And I very much commend the organizers for putting that on the program as well, because the changing shape of the monetary system going forward is going to be a really crucial theme in the next couple of years.
Thank you very much, Hyun. Now, we still have 2 minutes left and one question has just come in, and I'd like to cover this because it is very important for the themes of the events today and for the mission of AMRO in general. So the question is, given that you don't see a loss of confidence in the US dollar, how important is it for ASEAN members to increase inter-regional use of local currencies for their economy and financial resilience? And where should this effort move in terms of other initiatives to boost financial stability in the region? And this one is by Jono Thompson from Central Banking.
Very good. So I think that's a very important and very practical question. And there are several aspects to this. The way that global value chains work is primarily through the US dollar, because this is the currency that all of the trading partners would find common acceptability in. So if you invoice in US dollars, the other components of the global value chain would also find that acceptable, and so there is a mutually reinforcing aspect there. So to some extent, the issue is about the invoicing currency. And of course, the invoicing currency goes together with the short-term funding market, because if you're going to invoice in a particular currency, you need the short-term funding market to provide you with a working capital while you're actually repaying those invoices. So the financial system is actually a very integral part of the trading system in that regard. And if you see the short-term funding market develop that way, then the financial institutions, for them, these dollar denominated claims will then form part of the financial system, which then builds another layer onto the pyramid. So to that extent, it's not an easy solution simply to change one aspect of this and have that change the status of the dollar. But it has to be a multi-pronged and multifaceted approach. So to some extent, it's about invoicing, but you need to develop the short-term funding markets together with that. And then there has to be the fungibility of those funds when you're interacting with firms outside the value chain. And so you need to have invoicing in a currency which would find widespread acceptability across the world. So it's also not simply the ASEAN countries' actions that's important. It's also the actions of the currency that's being issued by the ultimate, consumer country as well. So I'm afraid there's no simple answer there. It's something that's going to take some time. It's going to take a multi-pronged approach.
Okay, thank you very much, Hyun. Now my screen in front of me is flashing red, which I think means that we're out of time. Hyun, you mentioned not getting a good night's sleep. You had to wake up very, very early in the morning for this session. So please, if the audience could join me in thanking Hyun Song-shin. Thank you very much, Hyun. Now we're going to move straight on to our second panel. So I'd like to invite the panelists up onto the stage to join me. And we have Mr. Zeno Ebenoya, Deputy Governor from the Central Bank of the Philippines, Mr. Minzu Kwon, Deputy Governor from the Bank of Korea, Ms. Alicia Garcia Herrero, Chief Economist for the Asia Pacific for Natixis, and Mr. Arab Ghosh, Chief Rate Strategist for ASEAN and Korea at Standard Chartered. Please, a round of applause for our panelists. Now, the topic for this session is implications for monetary and financial stability of the changing global financial landscape. And I think this is a topic that flows very naturally from the discussions that we've had so far today, and I think is a very appropriate way to round out the day. Now, as I mentioned earlier, the session this morning highlighted how on the one hand we have increasing fragmentation of the global economy, but on the other hand, when we look at the ASEAN+3 region, in many respects we see ongoing tight, in fact potentially even tighter integration of the economies there. We then heard from Julia Leung and Hyun Song Shin that when we look at finance at the global level, we're not seeing fragmentation. In fact, we're seeing increasing integration and linkages there. Now, this integration brings benefits in terms of helping global capital to flow to more productive uses, and that's particularly important in an environment where jurisdictions have very different demographic profiles, very different patterns of saving, potentially very different investment opportunities, very different outlooks for productivity growth. But as always with financial flows, there are risks involved, and Hyun highlighted very well, I think, some of those. This, of course, is an aggregate story, but to really understand what's going on, we need to look beyond these global aggregates, look at individual regions, individual jurisdictions, home in on individual financial markets and products and institutions. And I should say that this session is about changes in the global financial landscape as a whole. And when we're looking at the ASEAN+3 region, you need to go beyond financial markets and also consider developments in payment systems and technologies, which is an area where, as we heard this morning, this region is really at the forefront. So we have lots to discuss. There are many questions, and I'm not the person to ask to answer those questions. So we should move on to the panel. Now, in terms of formats, I'm going to ask each of our panelists to give some opening remarks. To provide some structure for that, I've asked each of them to speak about what they see as the most significant changes in the ASEAN+3 financial landscape over the past 5 years, or what they think will be the most significant changes over the next 5 years. And after that, we'll move on to the question and answer session. We'll go from left to right. So Zeno, over to you.
Thank you, Daniel. Again, thank you to AMRO and BIS for inviting us to this forum. There are indeed a lot of developments right now that is affecting performance of individual economies in the region. For one, the change in the attitude towards trade, international trade, has been a major focus in discussions right now, and that debate could last for a long time. So the issue on economic fragmentation could be with us for some time. We've seen it affect real outcomes in different economies, but it may also eventually see itself in the functioning of financial markets. For the most part, we have seen some economies building some resiliency to this economic shock so far. For example, there have been front-loading of some of the economic activities. The technology cycle is still there, and that has helped prime economic activities so far. And at the same time, if you look at financial markets, we are trying to understand whether they have already incorporated a lot of the implications of this economic fragmentation. If you look at Philippines, for example, the CDS spreads for Philippine sovereign instruments have gone up, but not so much given the increase in policy uncertainty, the anticipated economic shock. That hasn't been seen in some of the financial market indicators. So I think that's one trend, economic fragmentation, and how that could be incorporated or digested by financial markets. There were lots of discussions on emerging technologies and their implications on the banking system, how they operate, how they adapt these technologies. So probably that is also one trend that could have implications moving forward. And then finally, related to that, the talk about tokenization, stable coins. We are trying to understand what that means moving forward. So in some sense, there's this visioning exercise of what the world will be 5 years from now. Will some private sectors have gone ahead? Where will governments, national government, position themselves? And central banks at the heart of the monetary system and the payment system. How will they evolve in this world that we see that is fast evolving? So we think some of those, these are some of the things that we are looking at right now.
Thank you, Zeno. And I think that was a very nice stage setting, giving an idea of sort of the potentially enormous changes in the financial landscape in this region that are currently going on. Now, I'll ask Minzu to give his thoughts, and understand, Minzu, you'll be focusing in on sort of one particular aspect of changes in the financial landscape in this region.
Thank you, Dan. And I would like to thank AMRO also for having me here today. The biggest buzzword in Korea nowadays is stablecoins, whether we should issue Korean won stablecoins or not, and also whether who should issue these stablecoins, non-bank institutions or commercial banks. So I think it's a meaningful time for me to present to you today that what Bank of Korea is thinking about and how we are balancing between this innovation and trust in issuing Korean won stablecoins. So I prepared some slides, so I will go over the slides with you today. So I will talk about opportunities and challenges in stablecoins. So put it simply, stablecoin is a form of private issued money that uses new digital technology. So the essential question here is this: can private sector innovation successfully improve the way money works? Or will it create new risks that traditional central bank managed money has historically helped us avoid? This presentation focuses on both sides, the opportunities and challenges, and how Bank of Korea is approaching them. First, let me start with the opportunities. Stablecoins offer clear technological innovation. They are issued and transferred on blockchain rails, a system that operates globally, anonymously, and 24 hours a day. Because they are programmable, stablecoins can embed conditions for payments. Stablecoins can also streamline cross-border payments. Instead of going through multiple intermediaries, individuals could send money overseas with just a few taps on their smartphones, faster and at a lower cost. As more assets are tokenized into small digital units, stablecoins could become a key means of settlement in this new environment. However, there are also major concerns. If stablecoins are issued by private companies, can they really maintain the promise of one coin equals one Korean won? This promise depends entirely on the issuer's reserve assets and operational capacities. History gives us warnings. During the US free banking era in the mid-19th century, many banks issued their own notes. Because each bank held different qualities of state bonds as collateral, the banknotes were not equal in value, even if they had the same face value. This shows that the money is not just about technology, it is about trust. So ultimately, the question is not, is the technology possible, but rather, is reliable trust possible when issuance is decentralized? So let me now explain the key risks Bank of Korea sees. The first risk is depegging, the loss of stablecoins' price stability. Even the top two global stablecoins have shown price volatility when market stress occurs. Non-US dollar stablecoins have shown, as you can see in the chart, even larger fluctuations. A well-known example occurred in early 2023 when USDC temporarily fell to 88 cents after Silicon Valley collapsed. The issuer's reserves were partly held at the bank, and once trust in the bank faltered, the trust in the stable coin fell as well. So why depegging happens? This volatility happens because stablecoins operate outside the central banking framework, and therefore do not satisfy the principle of singleness of money. With bank deposits, 1 Korean won in Bank A is always equal in value to 1 Korean won in Bank B, because both are fully backed by central bank money within the payment system. Stablecoins, on the other hand, differ by issuer, by their reserve composition, their risk level, and their governance. As a result, one stablecoin is not always equal to another, and maintaining a stable price becomes very challenging. The risk number 2 is coin runs. The second major risk is coin runs, which is digital age bank runs. Even if an issuer holds 100% safe assets like government bonds, runs can still happen. Bond prices fluctuate, and in moments of stress, investors may rush to redeem at the same time. In a digital environment, trust can collapse at unprecedented speed. With a single click, millions of holders can attempt to redeem simultaneously. This could trigger forced selling of reserve assets and spill over into traditional financial markets much faster than classic bank runs. Third, we must consider consumer protection gaps and regulatory challenges. If an issuer fails to honor redemption, stablecoin holders are not protected by deposit insurance laws. And because issuers operate outside the central bank system, the central bank cannot act as lender of last resort. And also, blockchain's anonymity increase the risk of money laundering. According to chain analysis, 63% of illegal crypto transactions in 2024 involved stablecoins. For Korea, another concern is capital flow management. Korea monitors foreign exchange flows for economic stability, but stablecoins can circumvent existing regulations. While blockchain transactions are traceable, identifying the people behind them is extremely difficult. All of this raises questions about how to align stablecoin rules with existing capital and FX regulations. Other concerns include shrinking bank deposits and thus reduced lending capacity, and weakening monetary policy transmission. So what should we do? I will introduce POK cases. So given these risks, the Bank of Korea position is clear. We must build a strong institutional framework so innovation can grow safely on a foundation of trust. So first is a bank-centered issuance model. If a Korean won stablecoin is introduced, Korean banks should be at the center of issuance, either as the issuers themselves or through a consortium led by banks. Banks already operate under strict capital and FX rules and have the governance culture needed for compliance and financial stability. This makes coordination with monetary and financial policy much easier. Non-bank tech firms can still participate by joining bank-led consortia. Second, a cross-agency policy committee is crucial because stablecoins have implications for monetary policy, capital flows, and the broader economy. Major decisions should be made through a statutory policy committee involving relevant government agencies. So my final slide is the coexistence with the deposit tokens. This is what Bank of Korea think about how we can complement stablecoins with deposit tokens. Bank of Korea has also accumulated significant digital currency expertise, including through the project Hangang. One takeaway from these experiments is the potential of deposit tokens, which is blockchain-based representation of bank deposits. Deposit tokens can offer many of the same benefits as stablecoins while preserving transparency and preventing capital flow circumvention. For this reason, Bank of Korea sees deposit tokens as a strong complementary tool, possibly serving as a backup to privately issued Korean won stablecoins. To conclude my presentation, central banks and policymakers must continue hard to ensure that stablecoins do not undermine monetary and financial stability. Stablecoins could become a key that unlocks new possibilities in global finance, or they could become the source of new vulnerabilities. The real question is how we build trust, not just technology. Bank of Korea hopes to work together with the ASEAN+3 community and with the private sector to design safeguard that enables innovation while preserving stability. I'll stop here. Thank you.
Thank you very much, Minzu. That was not only a great introduction to an important issue in the ASEAN+3 financial landscape, but I would also say just a fantastic primer on stablecoins. So I think we're all very privileged to hear that. Now we're going to move on to hear from the private sector. Just before we do that, I'd note if you have questions for the panelists, now you should go ahead and start submitting those. As Minzu was talking, they were just rushing in, so if you have questions, get ahead of the queue and start putting them in. Alicia, I'm very interested to hear what do you have to say here. What do you have to say from the view of the private sector on the financial landscape?
Thank you. Well, you gave us a lot of homework, lots of questions. I'm going to try to pull them together. It was about financial fragmentation, Global financial fragmentation, are we there, are we not? Where is Asia in all of this? So I'm going to try to address those questions. So I'll perhaps summarize what I'm going to say with this idea of Asia's financial paradox. And what I understand by paradox is that 20 years down the road, and this is the time I've been in Asia, kind of I started with global imbalances and I end with global imbalances, yeah, and that's where we are. So for the last 20 years, and it is even more true today, Asia has been accumulating current account surpluses. We have economies out there with 15% of GDP in a current account surplus, that's Taiwan, and many others. Yeah, Vietnam, huge current account surplus. So when we look at that for an economy that basically contributes the whole of Asia to half of global economic growth, you may understand that, okay, the logic of this is that we have outflows from Asia, which is true. 2025 up to date, we have huge portfolio outflows from China, notwithstanding a very good stock market performance, generally from ASEAN. A little bit of FDI into ASEAN, but overall, basically, outflows. And the question really is, so this is net outflows. So you say, okay, this makes sense. We have, surpluses, real economy surpluses, notwithstanding Trump's tariffs. So everything is back to where it was 20 years ago, just bigger. But the difference is that there's been a lot of efforts, yeah, in at least gross-wise, maybe not net-wise, to have those older, rich, capital-rich, saving-rich Asian countries invest in the rest, yeah, in the high-yield ASEAN economies. But when you look at the numbers, you don't find that that has actually been confirmed, except for FDI, but not for the bulk of it after 20 years. So that's what I call the paradox. Why not? Yeah? Many institutions in the room have tried very hard with different initiatives, Asian Bond Market Initiative, Asian HKMA Initiative, you name it, yeah, and we're still here. And really, it's really a paradox for me. At the same time, we have also had, of course, among all of these Asian economies, kind of an outlier, if I may say so, in terms of economic power, soft power, you name it, which start to be reflected in the currency. This is obviously the RMB. You have a new, 2015 already, not so new, international payment system, CIPS, growing massively. So, you could argue you have the seeds, but it's still, yeah, we just aren't there. At the same time, and increasingly this year, we start to all discuss this potential de-dollarization, or at least slow dollarization, if I may say so. But the numbers don't really confirm that. We have 90% of Forex transactions in dollar. We have 50% of SWIFT transactions in dollar. And we have an even faster growing financialization of the US than even Asia by all means. So we have around 100 trillion in total credit assets in the US and around 50, half in Asia. What is most interesting is that when you look at what I call mature assets, so banks or, the difference is actually converging somehow. Where it is diverging is in the new type of assets, private credit, you name it. So then the question really is, why? I mean, why are we seeing the US still dominating in these financial transactions if the US economy in terms of, in relative terms is shrinking compared to the rest of Asia? So what are the reasons? Is this something we're comfortable with? One could argue if we've been comfortable for 20 years, why not now? Well, the difference now is that we start talking about potential de-dollarization. So, if you sit on all of these assets, you're a net creditor, maybe, you start worrying. So why isn't this happening? So I was thinking, just by the mere fact that what is growing the most is the least regulated part of the US financial sector, maybe that is one of the reasons. Yeah, one of the reasons is that the US basically moves faster in terms of financial innovation, and increasingly, and this is mostly the Trump administration, financial deregulation. I'm not sure whether this is good or bad, going back to the presentation by the Bank of Korea, but it is something that, in my view, is behind this paradox. That no matter the need and the complementarity of old and rich Asia versus, young and kind of high return Asia, you still miss the assets, kind of the dynamic assets, yeah, the liquidity, the innovation that you find in the US system. And that is beyond the currency, in a way. So the question is, if Asia is comfortable with this, we're all fine. But if Asia is starting to be worried about this exposure, then the only way out is to move further, yeah, on opening up. This is, of course, for some capital account, and this is not only China. I mean, it, in a way, it refers to many other countries, whether it's regulatory-based or not, regulation-based or not. So is Asia ready for this? Is Asia ready to kind of come back and bring capital back into Asia with what that means? Because it will have consequence on the real economy, on those imbalances we've been talking for 20 years. But maybe this is the time, yeah, because we're worried about that exposure. But if that's the case, really, the institutional changes that need to be introduced are massive. And that's just what I wanted to say. Thank you.
Thank you very much for providing that really nuanced color on this real fragmentation, financial integration story that we've been talking about. And I love that phrase, Asian paradox, was it? I think that's what I think that we'll be taking away with us today. Arup, let me hand over to you for your thoughts.
Good afternoon. Thank you, AMRO and Dan, for giving me this opportunity to participate today. I'll look slightly at the brighter side of things and would try to address two questions. What explains the resilience of ASEAN?
Arup, I think we have a microphone there.
Sorry. Good afternoon. Thanks, AMRO and Dan, for giving me this opportunity to participate in today's forum. I'll try to look slightly on the brighter side of things, and my learned panelists have already spoken in detail. So I'll add a few points and summarize and address two questions. First, what explains the resilience of ASEAN plus financial markets? What has changed? And second is what more we can do in terms of the prospects for deeper financial integration. So starting with the first, what we have observed is the regional economies have been much better and proactive in terms of securing FX swap lines with major central banks in the region. And that has been providing the backstop during external vulnerabilities. Second is, a lot of the central banks in the region have learned lessons from the previous financial crisis, and they have been building up their FX buffers. If you look at the FX reserves number, we have seen a tendency to build the reserves during a weaker dollar environment. Here, I want to highlight two separate things. If you look at FX adequacy, the first is rising import cover. But we have also observed the second factor, which is reducing the dependence on short-term debt. So in some of the countries in the region, we have seen a preference to issue more longer-term debt or to extend duration or increase the weighted average maturity of existing debt, as well as pursue debt switch program. So all of these basically reduce the refinancing risk of the countries during times of external vulnerability. As my learned panelist already mentioned, we have seen Asia's current account surpluses improve. Most of the economies are running large current account surpluses. A few are running smaller deficits, which basically reduce the reliance on foreign funding. Here I want to highlight the difference between Asia and LATAM. If you look at foreign ownership of local currency debt in Asia, it's mostly less than 20%. In fact, it's between largely 3 to 15% with a few exceptions. Whereas in case of LATAM, you would see the foreign ownership of local currency debt is much, much higher. So talking to a lot of investors, we understand that the reason why they invest in Asia is not because it's a high-yielding market within the EM context, but because the FX volatilities are much lower. So, they have more conviction in investing in the region, even on an FX hedged basis, because they know the central banks have more ammunition to prevent FX volatility during times of stress. I think one difficulty for the countries in the region, and what we have observed particularly after Trump came in as president, is FDI outflows as part of the US trade deals, as well as retail equity outflows. I'm sure BOK would be well aware of it. In case of Korea, despite running very strong current account surpluses, we have seen this theme of FDI outflows to set up manufacturing facilities in the US, as well as retail equity outflows that have put pressure on the currency. In terms of increasing the resilience of local currency market, a very important factor is, I think it was mentioned in one of the prior presentation, is the participation of local NBFIs, particularly insurers, pension funds, and mutual funds. So we have observed that these investors, which are more sticky in nature, are increasing their investments in local currency market. And that has reduced the dependence on foreign funding. Two of the countries, one is Korea, of course, is going to be part of the WIGB index, and we are also hopeful that Philippines would also get part of the GBI index. So these potential index inclusions actually attract more sticky EM benchmarked money into the region. Now, moving on to the dollar story, we think it's important to differentiate between the cyclical weakness in the dollar and the structural story. Now, what happened in the first half of the year is there was a lot of pressure on US companies to stockpile their inventories. In other words, front-loading their imports, and Asia being largely an export-dependent region, it benefited from front-loading of trade and exports. So that was one of the reasons for the dollar weakness. The second was, of course, Fed rate cut expectations. However, as it was shared in a lot of the presentations, the structural de-dollarization story is overblown in our view. The reason is because when we speak to a lot of the foreign asset managers, they say that they have hedged their dollar exposures, but they haven't reduced their dollar asset exposure. In other words, it's more of an FX hedge rather than reducing the risk of the underlying securities. And the second is, if you look at, I think it was mentioned in many of the comments that the share of dollar in cross-border payments is still quite large. So it's more of a cyclical weakness in the dollar rather than a structural shift away from the dollar. Trying to move to the second part, what can we do more in terms of the prospects? There has been, of course, much progress in supporting cross-border payments via fast payment systems. We know about the QRIS in Indonesia. In Thailand, we have the Prompt Pay. However, these systems are more country-specific. So the authorities can actually come up with a more regional application that can house various QR codes and systems that will help travelers and foreign workers to meet their FX needs for spending or remittances. We have also observed this phenomenon of lot of intra-region tourism. I mean, if you look at some of the tourist hotspots in the region, we observe that there are a lot of inflows from Asian tourists into Asian countries rather than depending a lot on overseas tourists. So that's also supports the FX needs for tourism purposes. As we understand at the regional level, ASEAN is also moving forward with a regional payment connectivity via an ASEAN-wide QR code. Having said that, as was mentioned, there is need for more cybersecurity and AML monitoring. Finally, these initiatives can be scaled up further so that not just they meet the requirements of travelers, tourists, or foreign workers, but also corporates can settle their outstanding balances, payments in local currencies rather than using the US dollar as an intermediary that adds cost to the process. And of course, we would prefer to have less FX mismatch, both tenor-wise as well as currency-wise. So to summarize, Asia has been vulnerable because of the US trade tariffs, particularly after the Liberation Day. But if you compare with other emerging markets, it has definitely fared much better, both in terms of the local structural support as well as reduced FX volatility. But going forward, it would help if ASEAN+3 can widen the digital payment systems into a region-wide framework rather than just being country-specific. I'll stop there, Dan, and pass back to you.
Thank you very much, Arup. And I think that message about regional financial resilience is a very important macro story for the region, over the past 6 months or so. Now, we'll move on to the Q&As. Just looking at the ones that have come in, there are a lot on stablecoins. So what I'm going to do is I'm going to ask a few questions. We'll take the ones that are not about stablecoins first, just to make sure we cover a few of those, and then we can answer all the stablecoin questions that people have. So let me start with one of my own. Now, when we think back to April, so 6 months ago, there was a lot of talk, given the events there, that we were at something of an inflection point for the global financial system, and that we could expect to see large shifts in portfolio allocations, long-lasting change in cross-asset correlations, as some previous safe haven assets were no longer perceived as such. Looking 6 months down the track, at least looking at equity markets, you're not really seeing any of that. So my question to the panelists is, have we actually seen any persistent changes in financial market participant behavior due to the events in April? Or was it really just merely a temporary blip the markets have moved past? Now, to be fair, I'm going to go in the opposite direction this time, but Arup, I'll give you a bit of a break. Alicia, do you want to come in on this one?
Yeah, I think we've seen a few changes beyond, of course, the increasing role of stable coins, but also hedge funds in the US Treasury market. I think that's important also. Europe much more invested in the US than it was in portfolio flows. That's also important. So I do think that there's been quite a lot of relevant changes and we've not even talked about what is going to happen next year, which is all of these commitments to invest in the US probably being deployed. So, looking at all of that is, in a way, what is missing in that picture. So if you think about, stable coins, hedge funds, Europe in the US, and FDI, mostly from Asia and Europe into the US, again, we're missing the liquidity pools in Asia, going back to my point, that would develop those, safe assets that you need to you yourself develop those stable coins that would compete with those in the US. So in a way, what I think I'm missing, and hopefully 2026 we'll see more of that, is those liquidity pools in Asia. Yeah.
Okay, so we're seeing something, but maybe it's a little bit below the surface, and some other developments have to happen to really give it a kickstart. Arup, do you have any views on this one? And I should say, for panelists, feel free. We have lots of questions, so if you'd rather move on, we can. Minzu.
When you looking back at the April and this Liberation Day, I think it was about time when we had a ASEAN+3 deputies meeting at that time also. So yeah, at the time there was a huge shock to the market, and I think it's because of this policy changes, mainly in US. regarding trade policy. And this kind of uncertainty shock gave a big shock to the market. And when you think about it right now, it's not like a break of system when you look at it. But the shock that came at the time was inevitable when you're looking back, because at the time, the market was somewhat stretched also. Because when you look at the equity valuation, and there was also worry about inflation concerns, and also a big worry about fiscal deficits. So all this combined, I think it was a shock that broke what we've been used to for many years. Like, those safe assets didn't act like safe assets at the time. But I don't think it's just a noise now. I think it's a gradual change going forward to this, not break of the system, maybe change of the system. So I think it might be a warning sign. So I think we need to, look after for the next some shock, which if then gives the same, correlation, that uncorrelation, or that we are not used to, then I think we need to consider this issue more deeply and be concerned.
Thanks a lot. And I think that really comes back to the resilience point. It was a very large shock, but the financial systems in the region were able to adapt to that. And maybe that's why we haven't seen such visible effects as one might have expected. Zeno, would you like to come in on this?
Thank you, Dan. Maybe just a few quick items to share. For the part of the Philippines, what we have observed is that with the uptick in uncertainty, both in terms of trade policies and those related to geopolitical tensions, we've seen some initial outflows from financial markets, but that was relatively short-lived. We have seen inflows, but the composition has changed. For the equities market, the inflows were relatively slow in coming, but there were more inflows going into the domestic government securities market. And some of this may be related to the monetary policy cycle that was adopted since last year. And also, to some extent, the interest in GS also was driven by domestic investors. I think pension funds, insurance companies have found GS to be attractive in the current environment. We have also seen, in another dimension, flows in terms of foreign direct investments. And here, some of them continue to be driven by perhaps longer structural trends, investments on renewable energy, investments on electronics as they prepare for the growth in the technological cycle. But there are also those that are related to trade diversion effects. So we've seen some interest, some initial flows that are related to that, as some companies tried to diversify their sources in the supply chain. And that's also something that we have observed, both in terms of actual inflows as well as inquiries since the second quarter of this year. So I stop there.
Yeah, I'll add a few points. I think it was mentioned in one of the earlier presentations on hedge ratios. I think it's part of a feedback loop that when a pension fund or an insurer or a corporate thinks that the dollar is going to remain strong, there is a very high bar for converting the dollar into local currency. In fact, what we observed earlier this year in case of Malaysian ringgit, because the corporates were repatriating back, the ringgit actually ended up being one of the best performing currencies in the region. If you look at Korea, the hedge ratios of some of the pension funds are very, very low. And that's part of the reason why the Korean won is weak, even though the economy is performing very strong. And finally, in terms of Asia's strong point, in terms of negotiations with the US, where Asia benefits is its first is of course going up the value chain, and second it's a predominance in some of the key industries like AI, HBM, chip manufacturing, semiconductors, and that gives it a lot of leeway in terms of discussing with the US. And if these NBFIs or the corporates stop having the feedback loop of a stronger dollar, and the money, part of that money can be brought back into the region and invested, we have seen what that can do to FX stability in the region.
Thanks a lot. And I think that leads very, very nicely into the first question from the audience that I'll pose to the panel, which is the perceived resilience of ASEAN financial markets over the past decade or so a function of a benign global environment, in other words, largely good luck? Or is it the result of fundamentally stronger divestment of domestic policies, domestic institutional structures? And so, given a very large global risk-off shock, how should we expect financial markets in the region to react? Would anybody like to take that? Minzu?
I think, Asian countries, we've been gone through like crisis, like a couple of times, Asian crisis and global crisis. So I think we put up with good measures, policy measures to prevent this kind of thing happening going forward. So up to now, being resilient is, I think, because of those kind of measures. But what I'm observing nowadays is somehow the structure has changed. For example, Korea, like Arab mentioned, we have a significant current account surplus nowadays. But our exchange rate is going up. That is, Korean won is depreciating. The reason for that is that our pension service is investing heavily overseas, and also our domestic investors are also investing heavily overseas. The reason for that is, I think, one of the policies that we put in through took part. That is that in order to prevent future crises, in the past, we put policies to prevent foreign investments from coming in too much. But nowadays, I think we need to reverse this policy because too much outflows are going abroad because of obvious reasons. The pension is growing significantly, and our domestic market is relatively small. So if the pension fund invests everything into our domestic equities market, it will have a significant impact to it. And so they diversified into overseas markets. But since they're growing, they are investing significantly, heavily overseas. And initially, they wanted to hedge. Our hedge ratio is somewhat low is because still the domestic hedging market is relatively small. So pension funds, they invest long-term investments, but they cannot hedge, long-term. They need to roll over short-term hedges over and over. So that's giving pressure to the domestic swap market and also FX market. So they decide not to hedge. And with this dollar strength and US exceptionalism, it works somehow. But exchange rate is going over the level that we think we didn't experience unless there was a crisis. So in general public's mind, they think that when certain level goes over, then there will be a crisis. But I don't think there will be a crisis because the landscape of our assets overseas and liabilities overseas has changed significantly since 2014. Now we are about a huge creditor to overseas. So even though the exchange rate goes up, it's not like in the crisis that our overseas liability is going to be problemsome. So instead, I think it's going to have some more income effect for people who invest heavily overseas. So I think actually Korean government and Bank of Korea is promoting more investment into Korean financial market. We're deregulating FX regulations. We have opened our FX market to 2 a.m. and now we are pushing for 24-hour trading till next June. And we've been included in the WICB index. So starting next April, huge inflows from those passive investors that follow WICB index will come in. And also, we are also pushing for the MSCI index inclusion. In order to offset this huge flows overseas from domestic investors, we would like to invite more inflows to domestic market from foreigners. So I think this is a structural change that we observe nowadays in Korea.
Arup?
Yeah, I think a good case study is Thai baht versus Korean won. In the third quarter, GDP, Thailand was weak, it was negative. Tourism is slowing down, inflation is negative. Even then, the currency has been strengthening because they are not able to recycle. And there is a strong home bias in Thailand. If you talk to the pension funds, the insurers, they invest in local currencies. So the assets are local money market funds, local equities, local bonds. So the excess liquidity gets recycled domestically. So despite a weak economy, despite slowing tourism, because of the gold correlation, Thai baht has been very strong, and the authorities are actually trying to weaken Thai baht. On the other hand, if you look at Korea, the third quarter was very strong, and I'm sure you'll be looking to upgrade your GDP forecast in the upcoming meeting. Even then, the currency has weakened. So that basically tells us how important the local NBFIs and their bias towards US dollar assets versus local assets that decide the future direction of currency.
Alicia, and I think Zeno, you want to come in as well, is that right?
Maybe just to...
maybe let's go with Alicia and then we'll come back.
No, actually, the Philippines is on that side too, so I'm sure it's going to be interesting, but I want to add the case of another hedge-reluctant economy, which is Taiwan. And because I think that makes exactly your point, but I think multiply by several times South Korea's case, in the sense that you have, and it is great to have all of these foreign assets. I agree that, you know, you're enjoying the kind of the local currency value of all of those net assets. But there is somebody intermediating this, yeah? And in the case of Taiwan is this insurance companies, yeah? And the fact that through, you know, that intermediation is happening without enough hedging is a big problem. So in a way, this brings me back to what I was trying to say at the very beginning, that, and I'm very happy that South Korea is doing this, is that really you need huge deregulation of Forex, of the Forex market. I mean, Taiwan is like, again, 1,000 times more in need, because if not, any of these big swings, and especially with weaker than, currencies weaker than equilibrium, Taiwan is a much bigger case again, it is quite scary in terms of, you know, the impact on solvency ratios for these insurance companies. So in other words, it does require, again, a growth of this domestic market, not to pull all of these eggs in the US basket, because whether it's cyclical or not, it still has a huge impact. So I think I'm just going back to my first point, for, again, like increasing the pool of liquidity, but also deregulating, especially the Forex market, so that hedging is cheaper, especially for these economies needing to put the money overseas in the US market. Yeah.
Thank you very much. Zeno, would you like to come in?
Maybe quickly, Dan. So for the Philippines, I agree with DG Minsu that the previous experience, the past 30 years, have been a learning experience for us. We've undergone through several challenging periods for the banking system, and both the private sector and the regulators have learned from that. and practices have been improved. On the regulatory side, there were also improvements in the regulatory and supervisory framework. Maybe perhaps another aspect will be the reforms, particularly when we opened up foreign banks more than 30 years ago, and that improved competition. It also introduced better practices in private commercial banking, and that has contributed to the resilience that we have observed in recent crises. Now, in the past 2 years, the other side of the financial system, outside of the banking system, we are pushing for capital market development. And one way that we have done so is through the back door. We're looking to improve the money market with the central bank introducing more market orientation in its operations, and that has contributed to the building of a benchmark curve that could go all the way to the longer tenors. And so we think that there's a lot of activities there, improvements in capital market development. We have improvements in the taxation over these instruments. The benchmark tenors have been identified, and that's why we're hoping we could be included in the bond index, hopefully sooner than later. So that has also helped keep the interest of the market on the Philippine financial market, despite all these external shocks that we're going through.
Arup, do you have a quick intervention, because I want to get to stable coins as well?
No, I just wanted to highlight, in case of the Philippines also, one important point is non-monetary policy tools. So because the rear was strong, so therefore the central bank can continue cutting rates. So it's important to use non-monetary policy tools like macroprudential measures or housing market regulations or FX interventions, so that the FX and the rate policy can work separately. I'll stop there.
Thanks. So that was a great question. It really touched a nerve with the participants, I think. The message that I take away is, yes, these financial systems are more resilient, but financial markets are very interconnected, and they change over time through technology and other reasons. And that means that financial reforms and bolstering financial system resilience is not a one-off policy change. It's a continuous process that has to match the changes in the financial market environment. If I could just add one point of my own, which is to say that the way in which you evaluate the severity of shocks is not to look at whether you're at a crisis or not. One of the reasons these economies haven't had crises is not because they haven't had big shocks. There have been large shocks, but the financial systems in the economies are just much more resilient. It's the way that many buildings in this region are built to withstand very large earthquakes. Whereas in other regions where the earthquakes are not so large, even a moderate-sized earthquake can lead to large damages. Now we have a question from the floor. Bob, please go ahead.
Yes, thank you, Daniel. I just wanted to make a little coda point on this FX hedging, and there's a cyclical element at work here. If you read the Treasury Fed foreign exchange report for the U.S. from 1985, mid-1985, there's an allusion to the fact that during the dollar's run-up to its peak in early 1985, that the hedge ratios around the world had systematically come down in a kind of Pavlovian process where if you were the outlier who hedged less, your institution did better, you got promoted, and so on. And then when the thing turns, you get a lot of just kind of rush back to the benchmark, which had been kind of cheated on in the interest of a profit, which was kind of reinforcing. So I think part of what we're seeing, the sharpness of what happened in the spring had to do with how long the dollar had been on average going up.
Thanks, Bob. And it's fascinating that these issues that seem so novel and salient now, in fact, were actually ones that people were grappling with so so many decades ago. Let's move on to stablecoins. We haven't got a lot of time left, I'm afraid, so I'm going to try and combine some of the questions that have come in into a small number. Look, one set of questions I think I can summarize as, what do you see as the use cases for stablecoins in this region? Do you think that stablecoins or their use will be material, or will they remain on the fringes of the payments ecosystem? And what do they mean for the use of local currencies, particularly in cross-border transactions in the region? Emcee, would you like to come in on this one?
Okay, yes. I think, stable coins, it makes you, transact more easily and cheaply. So the innovation aspect, there's plenty of opportunities. But still, when you look at it, the stable coins currently issued is mainly dominated by dollars. So for the reason, I think here is only a beginning stage. So, for example, the why Korean won stable issuance problem is buzzword in Korea is that, our cultural, K-culture, music and drama and the items deriving from those cultural things, those people who want to issue Korean won stable coins want to sell those items in stable coins. So they say that they can find some sort of a niche that foreigners can buy easily using stable coins when Korean won stable coin is issued. Because for now, there's still regulation regarding internet transaction of credit cards, because you need to identify yourself or put in your ID numbers in order to buy items from Korea. So that's their push, but still we are in a very beginning stage. So that's why Bank of Korea wanted to promote this innovation, but still wanted to have it done properly. So we don't want to have another crisis. We don't want to have another coin runs. So we want the bank to be involved because there can be a backstop. But still, because currently the stable coins are issued by tech companies, private companies, that doesn't have full backup when crises arise. Normal times is okay, but you have to think about the bad times.
Thanks a lot. Any other participants want to weigh in on what they see as the use cases of stablecoins? Zeno and then Alicia.
Yeah, thank you for that question. For the Philippines, there have been a lot of proposals actually from private sector to introduce stable coins in the Philippines. A lot of them are dollar-based, but there was one or a couple of them that are actually Philippine peso-based stable coin. And the proposals that we hear are primarily driven by possibility of cross-border retail transactions. This could include retail remittance or even transfers and payments. Some of the proposals also focus on the domestic use case, again for the very same thing, retail payments and transfers between local accounts. And we have actually gone through an exercise, a pilot. We have them in a sandbox where we can study how this technology could actually work in the real world. And so far in that limited sandbox activity, they have shown that there could be indeed gains in terms of having cheaper, faster, more efficient transactions for retail users. But we're very careful. We're watching what players are introducing, what they have in mind, what other jurisdictions like BOK has experienced. We're looking at the same dimensions that DG Minsuk has mentioned about the robustness of the reserve backing of these coins, the risk of the pegging, the transparency, the vulnerability of these innovations and help protect the consumers. We are also looking at transparency practices on the legal and regulatory contracts involving these particular transactions. So it's early days for us too. We're trying to learn from both the industry as well as the experiences of other regulators.
Thank you, Zeno. Alicia?
Yeah, so I just want to, I think the best way to summarize what I want to say is to read Lucrezia Reichlin's op-ed on Project Syndicate, whose title is basically "Stablecoins are unavoidable," and I can only tell you that that was kind of on the front, on the table of European ministers at the ECOFIN, our kind of reunion of ministers at the EU level, because we are struggling with this as well. Yeah, the kind of dragging our feet in Europe. Okay, should we do this? Should we not do this? Also on the back of a potential CDBC, so euro digital currency. The reality is this is unavoidable. And I think beyond, of course, how to design it, and I'm not in the best position to discuss that, and protecting consumers, macro, pro, you name it, I think what is very clear is that this is sucking savings away into the US. That's what is happening. This is Europe, this is Asia, this is everybody. And beyond whether this is the right time or not, and this brings us back to structural developments on the dollar, the thing here to realize is that it can be extreme, that we are only at the beginning. And because of that, I think there's no option but to rethink this at the local currency level, meaning Asian local currencies, same for Europe. Whether you can do this maybe in a coordinated way to reduce, to have more stop the risk, maybe in a coordinated way, I don't know. But I think we can't wait forever. This is what I would say even to European players in this field on the regulation side of stablecoins, because it can be much faster than any other financial development ever seen. And that's a risk for the world. And by the way, and I end, for global imbalances, because it's only making them worse rather than any better. Yeah.
So we have just 3 minutes left, but there's one more question from the audience that I'd like to ask you. Again, on stablecoins, do you see financial stability risks coming from these, even if they are fully backed by reserve assets or some kind of high quality liquid assets? It's a tough question. Does anybody want to take it? Minzu?
Yeah, it is. So this high quality reserve assets, meaning also central bank backing, or without central bank backing?
Let's say without central bank balancing. It was backing. It wasn't explicit in the question.
Okay, so then I think the pegging can break. So even though you have these reserve assets, I can break, even though we've seen this incidents, as I mentioned in my presentation at the Silicon Valley Bank incident. So that's why Bank of Korea thought about this tokenized deposit, which is backed by central bank as a reserve to this stablecoin collateral. So then I think we need to have this kind of institution framework that can really act as a backstop without only the private sector back it with their reserve assets, because asset prices can fluctuate at any shock that can make the value decline instantly. And of course, and we are using all cell phones nowadays. And when there's the holders of this stable coin want to redeem their coins instantly, then it can have a significant coin run instantly, and nobody can. I think no private company or tech company can backstop this.
Zeno, would you like to come in?
Yeah, maybe just quickly, there's a promise that it will be 100% backed by high liquid quality assets. But the question is, can we enforce it? Can someone monitor it? Can someone enforce it? Is the governance structure there? Is there a transparency mechanism attached to it? So probably that's also another layer of question when we look at the robustness of these innovations. So I'll stop there.
Alicia, Arup, anything you would like to add? Okay, so again, my screen is flashing red. If I can just, I think, summarize my key takeaways from the panel, I think there were three. One is the ongoing resilience of the region in the face of what I think have actually been some pretty significant financial and economic shocks over the past few years. The second is this dichotomy that we've talked of several times today between real fragmentation on the one hand and financial integration on the other, but which I think something that I think came out very nicely on the panel is that financial integration, yes, but in a very complex way. And I think this Asian paradox idea that Alicia brought up, I think is a very powerful one. There's underneath the sort of the headline financial integration, there's a lot of changes going on, and it's important for financial policy to keep pace with that. And the third message was definitely about digital payments and the developments there. Where I think what I took away is we don't know where the end state will be. So it's important for public institutions to be proactive and move with the times so they don't get left behind, but at the same time to be nimble because the technologies that we think might be the ones that will end up in heavy use in the future, it might turn out to be something very different. So that's the end of the panel. Apologies to people whose questions didn't get answered. There were just far too many, and these panelists were, I think, far too interesting to get through them all. But could you please join me in a round of applause for our panelists?
Thank you so much, Mr. Rees and our distinguished panelists. Please remain on stage as we would like to invite our panel to come forward to the stage and take a group photo together and capture this moment. Once again, thank you to our panel for your sharings on the insight on the stable coins regulations. And we're sure that our policies and framework will evolve and diversify just as quick as the new financial landscape change. Let's look at our camera and smile. Thank you very much to all our speakers. Please be seated. Thank you very much. After two rich and thought-provoking sessions, we have now come to the final segment of our program. Today, we have explored how the ASEAN+3 region can remain resilient amid the global uncertainties through cooperation, innovation, and sound policy. Now, to wrap up this insightful AMRO Forum, may I invite Mr. Abdurrahman, Director for Functional Surveillance and Research in AMRO, to give us the closing remarks. Please welcome.
Distinguished guests, colleagues, and friends, it has been a very productive and rich discussion since 9 o'clock this morning. As we conclude our fourth AMRO Forum, on behalf of AMRO, let me express our deepest appreciation to the Hong Kong Monetary Authority and the Bank for International Settlement for co-organizing this event. My sincere thanks also go to all speakers, panelists, and all participants for sharing your invaluable insights. Also, a special acknowledgement to our colleagues working behind the scenes. All your efforts have truly made this forum a great success. Our theme, from fragmentation to resilience, underscores the defining challenges of our region nowadays. We had listened and learned from several prominent panelists in 2 different sessions, along with 4 inspiring keynote speakers by Professor Tang, Professor Barry Egan-Green, and Mrs. Julia, as well as the latest Yoon Song-sin. I will not summarize the discussion, just highlight briefly. As discussed, the global dynamics are shifting rapidly, with trade relationships are becoming more complex, supply chains are being recalibrated, while technology increasingly intertwined with strategic and security considerations. In addition, financial systems are also transforming very fast, driven by innovation, digital platforms, and new channels for capital flows. These shifts are tremendous offer tremendous opportunity, while also presenting a new risk that must be carefully managed. Throughout the day, from the discussions, a clear message emerged. Resilience in ASEAN+3 cannot mean isolation. Our economies and financial systems are deeply connected. The path to resilience lies not in turning inward, but strengthening interdependence by diversifying partnerships, deepening cooperation, and building buffers that allow us to weather shocks while sustaining openness and competitiveness. To this end, strengthening cooperation will be critical by advancing digital finance and payment infrastructure, modernizing market regulation, navigating green transition, as well as reinforcing traditional pillars, trade and supply chains connectivity. In this endeavor, AMRO remains steadfast in its support. We will continue to provide thorough surveillance and policy analysis, capacity building, and strengthening the regional financial safety net as a cornerstone of market confidence and stability. The road ahead is complex, but today has shown our collective confidence and commitment. By working together, we can turn fragmentation into an opportunity to build a stronger, more resilient future. With strong spirit of collaboration, I believe the region can not only safeguard stability and ignite new engine of growth, but also stand as a beacon of shared prosperity in an increasingly fragmented world. Thank you very much.
Thank you very much, Mr. Abdurrahman, for your positive remarks. Ladies and gentlemen, this concludes the 4th ASEAN+3 Economic Cooperation and Financial Stability Forum. And before we close, we invite you to complete a short feedback survey. The QR code will be shown on the screen. After your submission, you will receive a link to the speaker's presentation. And once again, we extend our heartfelt appreciation to all our speakers, panelists, and all the participants here in Hong Kong, China, as well as our online audience. It has been my pleasure hosting this AMRO Forum 2025 for you. On behalf of AMRO, Hong Kong Monetary Authority, and the Bank for International Settlements, thank you once again for being here with us, and we wish you a wonderful day. Thank you very much, and goodbye.